9 a.m. live from the Nasdaq market site in New York City. I'm Shauna Smith alongside Brad Smith. This is Yahoo Finance Live, and here's your morning rundown. Israel orders a complete siege of the Gaza Strip after sudden attacks from Hamas killed close to 1,200 people over the last 48 hours. Iran rejects claims that it was involved as the U.S. sends weapons and warships to the region.
And the conflict comes as a U.S. Senate delegation arrives in Beijing. China's foreign minister says he hopes the visit would help the U.S. more accurately understand the nation. Senate Majority Leader Chuck Schumer using talks to immediately criticize Beijing's response to the Hamas attacks.
And auto sector woes continue. Around 4,000 UAW members at Mack Trucks go on strike after rejecting a tentative agreement. GM also in the crosshairs. A shutdown of its Canadian plants look more and more likely as a key deadline approaches.
Well, the Israeli defense minister has issued a total siege of the Gaza Strip, cutting off food, electricity, and fuel to over 2 million people. This after fighters from Hamas launched a surprise attack on Israel. The nation's military now saying it has regained control of its southern towns. Yahoo Finance's Rick Newman is here with the latest. Hey, Rick, what do we know so far?
Hey, guys. Obviously, a horrifying development. Hundreds and perhaps more than 1,000 people dead. And this looks like it is going to be a new Middle East war that is going to last for some time. Now, we've had Middle East wars before. The sort of relief to markets is that this does not directly impact markets. We did see a jump in the price of crude oil as this unfolded. That could last for a while. And now there are going to be many moving parts to this. You mentioned Iran. There's a question of how involved is Iran, since the group that prosecuted this attack on Israel, Hamas, is basically a proxy for Iran. So how involved is Iran? We're going to have a lot of speculation about that. We already do. There could be more activity to the north. There could be attacks on Israel from Lebanon in the north. So watch that. I think the main way to think about this at the moment is this is going to be a bloody mess for a long time. The U.S. obviously a staunch ally of Israel, so this is going to affect U.S. politics. And by the way, this all happens as the Republicans in the House of Representatives do not have a speaker yet. So this is going to be kind of a forcing function to get them to get their act together.
Eric, talk to us a little bit more just about the U.S. potential involvement here, what that looks like. We know that the U.S. is sending military planes and also ships closer to Israel today in show of support.
Right. I think it mostly will be weapons as they are needed. Yeah. Now, President Biden has said that for the moment, he has all the authority he needs and all the money is available or the weapons are available to give Israel whatever it might need. But this could also require some further congressional action. And this actually gets kind of interesting because one of the things the Biden administration was not able to get through Congress before the whole fiasco in the House last week was funding for Ukraine. Biden wants $24 billion for Ukraine, and that did not make it into those temporary funding bills. So that's a big question mark. It now seems like there's a possibility that if Israel does need something that requires legislation in Congress, that could actually be attached with something that would also provide funding for Ukraine. So that is one of the ways that the Biden administration might find opportunity in a chaotic and terrible situation. But there's broad support among both parties for Israel and Congress. So I think Israel is going to get everything it needs from the United States.
All right, Rick, thanks so much for really leading off the conversation here and continuing to track some of the developments as we are here as well. Yahoo Finance's own Rick Newman. Well, stocks, they are certainly reacting this morning as well here in the U.S. as you're tracking futures and seeing them on your screen down across the board for the Dow, the S&P 500, and the Nasdaq, reacting to conflict in the Middle East as investors flock towards traditionally less risky spaces like gold and the dollar. And we've certainly been tracking both of those. Naturally, many investors will look towards and look at gold futures. I don't know if we can toss that up on the screen as well, just to see where that move has been, at least as of this morning. That was one of the areas that I was looking at. But then additionally, even some of the moves actually in converse to that in Bitcoin, which is another one of those, but more risky assets, and of course looked at as digital gold at some point or another. That's actually moving to the downside here this morning, but you're seeing gold futures hold steady up by about 0.9% out of the gate right now.
Yeah, Brad, just the most horrific attack. We talked about the fact that the death toll continues to climb right around 1,200 and rising. We obviously know the human side of it, how devastating this attack is. But then also when you take into account or you take a look at what's happening now globally in terms of a market reaction to these attacks over the weekend. We're seeing the movement in crude. We saw oil prices spike over the weekend. We're seeing energy stocks moving to the upside this morning. Gold on the rise, like you said. Also, three major U.S. airlines. We have Delta, United, and American halting flights to Israel after the attack. So obviously the human side of it, and then also the market's reaction to this, and clearly an important movement here for investors to keep in mind this morning, as we certainly do have a lot of reaction rippling through the markets in response to this attack. And we just heard Rick Newman saying that this is something that could go on and likely to go on for quite some time. So questions just about the U.S. involvement going forward and what that looks like globally speaking here at this point.
One other area that I was thinking of this morning too, some of the top exports that people would be right to think about as well that come out of Israel, things like diamonds, integrated circuits, refined petroleum, medical instruments, and some other measuring instruments as well. Those all play into their broader economy. And so as you think about some of those top exports, no doubt that a part of the broader international equation that and international business that could be set to take a hit in this near term as well.
And we know Israel is also a key region for pharma and technology, especially autonomous driving. So certainly some traits to keep in mind here this morning. Well, futures are falling, like we've been talking about. Defense stocks on the rise amid the deadly conflict between Israel and Hamas. Now, shares of Lockheed Martin and RTX among the names in the green ahead of the open. Overseas, Europe's defense stocks are among the best performers on the day. And energy stocks are also higher as crude prices spike. Here to talk about that and more, we want to bring in Chris Versace. He is Tematica's Research Chief Investment Officer. Chris, it's great to see you. So first, let's just talk about the rise in geopolitical tensions right now, the threat that this potentially poses to the market. How are you assessing this risk?
Well, clearly it's an evolving risk. Details over the weekend, I think, caught some folks understandably by surprise, and we're watching the developments. But I think we got to step back a little bit because this is really just another layer of uncertainty that the market's dealing with. Obviously, here at home, we've got the extended UAW strike. We've got the strike that's going on in Las Vegas. We're hearing reports we're going to see additional strikes, perhaps from Walgreens employees. There's the big uncertainty about what the Fed is going to do. And we've got some big economic reports coming out this week, CPI, PPI, and about a dozen Fed speakers. So, when you come into today, what we saw unfold over the weekend is another reason that we're going to see the market, start a somewhat shortened week, if you will, given today's holiday, in a risk-off mode. And I think that explains exactly why we're seeing folks flock to the dollar, why treasuries are going higher, and subsequently the market selling off. Again, just a lot of uncertainty coming into this week, but even more so as we start the week off.
Chris, when we had talked about some of those top exports that come out of Israel and the importance there in terms of the international business community, when you think about what investors might look towards to try and figure out or get a gauge on how isolated this is and to what extent as well it may play out, what could investors look towards?
Well, I think the comment that was made earlier about this likely to take, some degree of time is spot on. And as a result, I think one of the biggest markets that we're going to have to watch is oil. It is trending higher. Remember, we had renewed concerns as we move towards the end of the year that if China's economy actually starts to pick up, that we might see some supply constraints. This could obviously, not, I won't say impact it, but it could obviously make it even worse. So we could see oil prices move even higher over the near to medium term. In terms of some of the other end markets that you talked about, Brad, you were talking about chips, particularly for autonomous driving, that sort of thing. It is going to be something to watch. I think the big question is how long does this really go on for? Typically when we're tracking the larger global economy, the four horsemen that we tend to watch are going to be the U.S., China, the Eurozone, and Japan. So, seeing how this impacts their imports, their exports, will probably be the first sign that'll tell us what the real impact is going to be.
So, Chris, we have this obviously adding another layer of uncertainty, like you said. Also, some commentary coming out from Fed officials just in terms of what the Fed could do. We know we had that very hot jobs print on Friday, bringing up some questions just about maybe the Fed is not done, and maybe, in fact, it is more likely that we'll see another rate hike before the end of the year. What are your expectations for Fed policy?
Well, you are right. A lot of the data that we've seen of late seems to suggest that inflation is stickier than expected. Clearly, the jobs report that we got last week with that, big number that came in, as well as the commentary that was found in the September Challenger Gray report, that while most people tend to focus on that report talking about the job cuts, if you read really below, it said that employers were looking to add about 500,000 jobs, a lot of it seasonal, but still a significant number of new jobs. So it tells us the economy, despite some of the other data we're seeing, appears to be stronger than expected. Also over the weekend, we've got the Manheim Used Car Value Index that actually ticked higher in September. And I suspect that's tied to what we're seeing unfold with the UAW strike. But again, another reason to think that later in the week, when we get the CPI, PPI reports, that they may not show as much progress. To me, those reports, particularly what they say about core CPI, both on a month-over-month, year-over-year basis, will really start to dictate how firm expectations will become for a potential Fed rate hike in 20 plus days.
Chris, since we're talking about the Fed, to what extent do you expect conflict internationally here now to impact the Fed's fight against inflation?
It's a great question. Again, it's going to depend on how long it plays out. There is the argument that some people will put out that, wow, this is another layer of uncertainty into the economy, could affect supply chains. It's another perhaps, notch for the Fed to say, need more time, got to remain data dependent. Because remember, too, that as much as everybody's focused in on the next policy meeting by the Fed, they do have another meeting in December.
So, Chris, how should investors be thinking about all this when you talk about portfolio positioning? What are some of the latest moves that you're making in response?
Well, we've had some exposure to energy, to gold. We were concerned about earlier this year the direction of the economy. Obviously, those are seeing some lift. We also had exposure coming into this to Lockheed Martin, which, as we talked about, is moving higher as a result of the weekend's news. But given the uncertainty and the rise in the dollar, my suggestion to viewers would be, think about businesses that are benefiting from stimulative efforts here at home. There's a lot of money that's going towards infrastructure spending, both the Biden infrastructure law, CHIPS Act, and the Inflation Reduction Act, and look for opportunities therein for companies that are really domiciled in the U.S., heavy U.S. exposure for their business. That'll limit the impact of the rebound that we're seeing in the dollar as well. Two companies that I would suggest would be United Rentals and Vulcan Materials, which we own, just to be clear, in the Action Alerts Plus portfolio at the Street.
Chris, we're about to begin another earnings season. And if there is any type of magical elixir or magic word that you expect to hear from companies, or perhaps how they're hedging some of their own forecasts, what would that narrative be that you expect to come from some of these C-suites at these publicly traded companies that we talk about day in, day out?
Yeah, I mean, we've got, as I just said, the dollar has been rebounding. That's going to be a headwind for multinational companies. We've got concerns about the consumer, especially as the return of student debt payments are unfolding. We've also got higher borrowing costs in companies that some of which will have to kind of rebalance their debt load next year. So potentially higher interest costs. So, what I want to hear is, hey, we understand all of these things, but we continue to see margin improvement ahead. To me, that's going to be the key. If you've got companies that can still deliver, I should say, margin improvement, that'll help deliver bottom line performance. But candidly, guys, I do think that expectations for the back half of the year might have been a little ahead of themselves. I am personally bracing for kind of a, wobbly earnings season.
Chris, what's one thing that you think investors should have on their radar right now heading into earnings season that maybe they're not thinking about, given the fact that there are so many headlines and it's tough at times to keep up with what investors should be digesting, what investors need to know?
It's a great question because you're 100% correct that, earnings season is a very, frenetic, violent time, if you will. We can easily get distracted. So I would say, before you go into the earnings season, which really, PepsiCo tomorrow, but really gets going later in this week with the big banks, is sit back and, remember, what is it that the companies you've invested in, what do they do, where do they do it, how do they do it, what are the key levers to pay attention to so you can be focused as all of this noise, hits. Again, what's going on with Israel, what's going on with the CPI, PPI, and earnings season, as well as all those Fed and speakers that we have this week. So know what you own and be prepared to act accordingly.
All right, for Q3 2023, according to FactSet, we do know 76 S&P 500 companies have issued negative EPS guidance, 42 have issued positive guidance, so a lot's still in that gray area there, at least for the S&P 500. Chris, thanks so much for taking the time here today. Always a pleasure to speak with you and kick off the week.
Thank you, guys.
Thank you. Well, Mack truck workers joined the picket line this morning. 4,000 members at Volvo's Mack Trucks voted to reject a tentative 5-year contract on Sunday. Yahoo Finance's Pras Subramanian has more on this story. Hey, Pras.
Hey, Brad. Yeah, kind of a surprise move here, Brad. UAW members at Mack Trucks rejected a tentative agreement by a 73% no vote of a deal struck by the two negotiating sides, the two parties last week. So the workers, as of 7 a.m. this morning, will walk off and join the picket line, striking at plants located in Pennsylvania, Florida, and Maryland. UAW President Shawn Fain said in a quote, "I'm inspired to see UAW members at Mack holding out for a better deal and ready to stand up and walk off the job to win it." Conversely, Mack Truck CEO Stephen Roy said he was surprised and disappointed, quote, by the rejection, claiming the auto truck maker bargained in good faith with the UAW. But nonetheless, members that had the final say here, Brad, they can say whether they want the deal or not. And it seems they didn't think it was good enough, I think, showing more resiliency than even the union thought.
Pras, when we talk about some of these issues here among union workers, bringing it back to the big three and what we're seeing there, GM at risk of potentially seeing a shutdown in some of their Canadian plants. Where did those talks stand?
Yeah, as of tonight, there's a deadline tonight, 11:59 p.m. Eastern. If Canada's Unifor Auto Workers Union doesn't strike a deal with GM by then, they'll also go on strike there. So the Unifor union saying that GM hasn't actually modeled the sort of pattern agreement that they struck with Ford earlier last month. So they're kind of surprised GM is not doing that. And there's some sticking points in particular with things like wage progression and benefits like retirement stuff. So there are some issues that are still kind of ongoing. And it seems that they're waiting to the last minute here to possibly make this move. And it seems like potentially GM another headache for them, at least north of the border.
Hey, Pras, how much of the same sentiment? I mean, we saw Shawn Fain, UAW president, wearing the Eat the Rich shirt at his most recent briefing. How much of that same sentiment cascades over when you think about the other negotiations that are taking place outside the UAW and focusing more on kind of that Mack truck worker?
Yeah, I think that T-shirt sort of said a lot about what's going on in this country and maybe elsewhere in terms of labor and sort of the potential to strike a lot of concessions from their negotiating parties. I think they think that this is the time for them to move. A lot of companies still making a lot of money, even in this situation where there might be some global uncertainty and some sort of concern about higher rates. I think the workers say, hey, you guys are making billions of dollars in profit. It might be our time. We saw that with Starbucks, saw that with the Screen Actors Guild and WGA, things like that. So I think that we're seeing that T-shirt is an indication of how far they can go. And I think the workers see that as a rallying point. Shawn Fain talking about how this is a righteous battle, using religious terms in terms of we need to help out the middle class, the lower class people right now. And I think that's sort of what you're seeing reflected here with Mack Trucks. I mean, this is a surprise move by the rejection. I think people did not see that coming. At least the Mack Trucks CEO didn't see it coming either.
All right, Pras, thanks so much for that update. I want to get back to the markets here just ahead of the opening bell. A recap of the top story this morning. Israel ordering a complete siege of the Gaza Strip after sudden attacks from Hamas killed close to 1,200 people over the last 48 hours, Iran rejecting claims that it was involved as the U.S. sends weapons and warships to the region. Now, taking a look at some of the reaction that we're seeing from a market perspective this morning, we have oil prices on the rise on the risk of geopolitical tensions rising. I want to get over to the New York Stock Exchange for a moment of silence. Just about 5 minutes away until the opening bell. Stocks under a bit of pressure following the attack on Israel, unnerving some investors as a result of this, the heightened geopolitical risk. Jared Blickery standing by with the latest on some of the movement that we're seeing globally. Jared.
Yes, we're seeing some a negative reaction, not surprisingly, but let me check out Tel Aviv first, and we're going to see that the stock market Monday versus Sunday is a little bit up, but you can see the brunt, which the market does trade on Sunday, is down 7.7% over the last few days. And let's take a look inside the market here in the U.S. We're seeing a rebounding in energy shares. That is about it when it comes to sector action. But some of the industries like defense are also doing well as well. The background when it's green, that's from Friday. We had a banner day Friday. Easy to get lost and forget that we actually overcame a pretty hot payrolls number and were able to close in the green, the best day in weeks. But we're seeing a different flavor to the markets today. So energy up about 3%. We have crude oil advancing about 3 or 4%. Financials here, XLF down about 1% in the pre-market. Real estate, materials, tech also taking a little bit of a hit there. And if we take a look at the energy stocks here, we can see Exxon, which was down 1.67% on Friday, is actually up almost 3% today. Chevron up 3.3% as well. I'm going to show you some more green on some other screens here. If we go to the defense sector, or industry, I should say, we can see a number of these names. RTX up 5%, Boeing up 0.3%, Lockheed Martin up about 6%. In a lot of these stocks, let me show you what's happened on a year to date. Some of these stocks have just really fallen out of bed over the last month or two. Here's Lockheed Martin, and here's RTX. So you can see this bid probably going to help them improve that picture a little bit in the pre-market. Before I go, I do want to check out what's happening in the currency market. And let's put these pre-market quotes off. And here we have the dollar versus the Israeli shekel. That is up about 2%, 2.5% today. You can see up 11.5% year to date. So the dollar strengthening against the shekel. The Israeli government has come out with the central bank almost unprecedented support for the currency. So not surprising to see a little bit of weakness there, but taking some lumps in the stock market as we saw yesterday, but recovering today over in Israel.
All right, Jared, thank you so much for continuing to keep a close eye on this, as well as some of the Israel-based trading companies, or companies publicly traded as well here. Appreciate that. Stay with us for the market open and for the opening bell. Let's also take a look at some other market movers this morning. We're tracking shares of Disney, ticker symbol DIS. They're moving higher pre-market. It's up by about 1.5%. Over the weekend, Nelson Peltz's Trian Fund Management increased its stake in the company and is expected to request multiple board seats. That's according to sources close to the matter. Now, Trian is one of Disney's largest investors. Their stake is over $2.5 billion. This is not the first time, though, that the Peltz Group is requesting a board seat. Earlier this year, he launched a run for a seat on the board, then withdrew after Disney announced a reorganization and cost-cutting plan. There were a lot of announcements, and many of those made very public. Bob Iger doing a lot of media thereafter and around that particular earnings call where he got back in the helm and was really signaling exactly how they were going to trim some of, dare I say, the fat around the company as it had been regarded as by some of the activist investors and campaigns that initiated there. And so after that earnings call, you saw the retraction of some of those activist campaigns. But given the fact that you're watching shares of Disney now trading lower than they were at that point earlier this year, it's only right that you could expect some of these activist campaigns to reinitiate.
And Brad, we're taking a look at a year-to-date chart right now. If you take a look at a one-year chart, you can see we're right around the 52-week low. So Nelson Peltz targeting Disney following an underperformance that we've seen from the company over the last several months since February when Nelson Peltz initially said that he was stepping away from this, that he was satisfied with some of the plans that were laid out by Disney. We've seen a significant underperformance by Disney, shares off more than 25%, so broadly underperforming some of the major averages there. We know that there's lots of questions just about what the future is going to look like for Disney. Iger certainly laid out a number of plans or a number of possibilities in terms of what direction the company could go in. We know streaming, obviously, very much a priority here for Disney going forward, but lots of questions just about the linear side of the business. It's drummed up some interest so far, certainly nothing that probably compared to what Iger was hoping to see when he initially said that he would be open to any and all ideas. So I think there's lots of questions just about what the future of Disney is going to look like, and then also what Disney looks like after Iger. We talk a lot about the succession plans or lack thereof, exactly who is going to potentially take over for Iger in several years. So just some things that the street is keeping in mind, and obviously Nelson Peltz not satisfied with the performance of Disney.
Yeah, the only other thing I'll add to this, remember just last week we were talking about some of the initiated coverage on U.S. media and telecom, particularly coming from Bernstein, and talking about Disney within that, and never being a more interesting time to initiate coverage on media and telecom, because what's being combined with the streaming video on demand, it's the advertising element and then the addition of some of that possible revenue intake as well for Disney.
All right, we want to get to the opening bell on Wall Street, doing a quick check of the markets. Again, some pressure here at the open for all three of the major averages. Jared Blickery standing by with a closer look, Jared.
Yes, not too much change in the sector action from the pre-market. Pretty clearly, XLE, that's the energy sector, that's up 2.5%. Industrials, not surprisingly, that includes a lot of defense names that we've been talking about, like RTX, Lockheed Martin. That's in the green as well. Utilities, a defensive sector in a different way. That's up just nominally as well. To the downside, consumer discretionary or retail, that is flagging about 1.2%. Financials, tech, and real estate are also among the underperformers here. Let's take a snapshot of the Nasdaq 100. We are seeing some strength, but in very few names. Pinduoduo, a Chinese stock, some defensive names like Mondelez, and then healthcare name Amgen. Those are in the green, as well as Honeywell. I'm noting that's also a defensive stock, but you can see largely a sea of red, but not dark red. So we're seeing a little bit of risk off here. NVIDIA down almost 2%. By the way, Intel actually has a chip plant slated for Israel, and that's kind of in the balance right now, kind of extending their operations over there. So it's going to be interesting to check out what happens in the chip sector today. But NVIDIA on a year-to-date basis still kind of treading water after its latest earnings announcement. And by the way, we got earnings this week. These stop for nobody. And as we take a look at some of our leaders here, we're actually seeing meme stocks. That's interesting. That's up 3.5%, that ETF, followed by junior oil companies there. We have defense. ITA is an IPO, is an ETF for that, as well as IPO. New York FANG stocks, that was an interesting development. Not seeing really too many of our FANG stocks in the green right here, but nevertheless, that ETF getting some love. I think it's going to take a few minutes to kind of settle down and see what the price action is looking like. Let's take a look at those defense stocks one more time. Aside from GE and a few others, looks like largely bullish price action, even Boeing up about 1%. Went through some of the charts in the pre-market, but a lot of these guys still kind of flagging from earlier losses over the last few months. Here's industrials. We do see some overlap here in the defensive names, but largely seeing green in that sector as well. We can check out transportation, more red than green there. The stuff that's shipping stuff, and also the airlines like American Airlines down 4%, with travel companies also taking it, and cruise line companies also taking it a little bit on the chin here. I think we can round out with a discussion of let's take a look at the meme stocks, see if anything's jumping there. Did see that ETF was indicating some action, but overall, not really seeing much in this sphere. So I think the fringier parts of the market have gone home. Even some of the mainstays, the mega cap trade that has worked so well for this year is kind of flagging as well. We'll have to see what the day brings, guys.
We will, and Jared, we will keep a close eye on that. Thanks so much for breaking down the action here at the open. Well, we want to shift gears a bit and focus in on the pharmaceutical sector, most specifically Bristol Myers Squibb shares on the move this morning, up just about 0.1%. Now, the company is saying that it is buying Mirati Therapeutic. It's a deal valued at up to $5.8 billion. Now, Mirati develops commercial oncology therapies. Following this deal, Bristol Myers Squibb will add several cancer medications to its portfolio. This largely being received from the street as a deal here that's going to further diversify Bristol Myers therapy, pharmaceutical drugs offerings here, in terms of the fact that they have seen a bit of pressure on some of their older drugs, the fact that some generic options have become made available, especially one that has to do with the blood cancer drug here, this third largest revenue driver that faced some pressure here from generic rivals, most recently in the quarters, weighing on the revenue outlook at the company. So this deal potentially bringing in new drugs to the pipeline.
Yeah, exactly. I mean, we're looking at this deal, and again, just the details of it, $58 per share. $4.8 billion equity value, up to $5.8 billion, including the continued value right. And then you think about where the companies are going to continue to kind of position this going forward from here, and the portfolio that they're really bringing together, at least from the chief executive officer and board chair at Bristol Myers Squibb. They did say in a statement that we are excited to add these assets to our portfolio and accelerate their development, seeking to deliver more treatments for cancer patients. Strong strategic fit, great science, clear value creation opportunities for shareholders. Mirati transaction aligned with some of those business development goals. And if you think back to what we've been talking about throughout this year, it's where some very strategic acquisitions could come to light or could come into fruition here as a result of either patent roll-off or needing to make sure that there is an accelerant or an accelerated effort in research and development, that R&D coming in the form of acquisitions here. So that is something to continue to keep an eye on, especially within this pharmaceutical and healthcare landscape.
Yeah, certainly.
Let's also talk about Zscaler shares this morning. They are on the move today, up by about 2.2%. This comes after Barclays upgraded the company from equal weight to overweight, also increasing their price target from $176 to $190. The analyst saying that the upgrade comes from the company's growth in secure access service edge. This is a cloud security-based system that protects user information that lives outside of the data center here. So very strategic play here that they're making in terms of, well, how Zscaler could potentially grow out from here. But we'll see exactly what type of investment they need to continue to make in their own business in order to bring that to fruition.
Yeah, and the cybersecurity platform, clearly one of the reasons, or really the reason behind this bull call here from Barclays. When we're diving into some of the reasons as to why, or the growth opportunity that they do see within this business, they see the secure access service edge here market could be as big as network security by 2026. They also note how Zscaler is a leader within this space. Obviously, the fact that that's giving them an advantage here when we talk about future growth opportunities going forward. When it comes to some of the numbers that Barclays is expecting to see from Zscaler, they raised their full year 2024 billings estimate. They also extended their model here for fiscal year 2026. They see billings growth of just about 20%. They also talk about the fact that they're seeing healthy free cash flow, margin expansion there. So obviously a bullish call here from the street, a lot of it having to do with cybersecurity platform and the potential for that to grow when we talk about demand and the importance, given the fact that we have seen obviously a massive uptick in the number of cybersecurity breaches.
It's been far too reactive. I think many companies, their chief information security officers, chief technology officers even, really having to acknowledge here. So now what is the proactive nature and how much of that spend could cascade through to a company in Zscaler here?
Yeah.
Yet to be seen.
Zscaler shares moving to the upside here this morning. All right, keep it right here on Yahoo Finance. We got all your market action ahead live from the Nasdaq market site. We'll be right back. Senate Majority Leader Chuck Schumer is criticizing China's President Xi Jinping over failing to condemn Hamas's deadly attacks on Israel. Now, Senator Schumer is part of a congressional delegation of 6 senators visiting China. This marks the first visit by U.S. lawmakers to China since 2019. Senator Schumer, when talking about Xi Jinping and the lack of response, he said, quote, "I urge you and the Chinese people to stand with the Israeli people and condemn these cowardly and vicious attacks." For more on this, we want to bring in Shahzad Kazi, China Beige Book International Managing Director. Shahzad, it's great to see you once again. Let's start with the back and forth and the criticism that Senator Schumer had for China's President Xi Jinping, just about the lack of response here from China. What are the more broad global implications of this and the risk that we're seeing as a result of the rise of the geopolitical tensions?
Yeah, I think this is just one additional item that you can add to in the places where U.S. and China simply don't see eye to eye with each other. And I think, the senator's trip, he's raised a series of issues which remain longstanding pain points from an American standpoint: the fentanyl crisis, the inability of American companies to get market share in China, the unfair competition, et cetera, subsidies. But the fact is that the United States cannot force China to do anything differently than China wants to do. And so you can have talking points in press conferences, but you're not going to make much progress beyond that.
So what is the significance then of, excuse my eloquence here, the non-sympathy from China on what's taking place within Israel right now?
Yeah, I think, China, along with lots of other countries, takes a slightly different position and take on the conflict. Of course, there's a bit of an international convergence around what a resolution to, this long-running dispute would look like. That, of course, has run up consistently against domestic politics in Israel itself and so forth. But, this, at the end of the day, from a market standpoint, is not going to be something that's going to, that is going to be creating more tension for them. The real area where markets would be focused is there anything new that's coming up on the U.S.-China policy front that we need to be aware of? But the fact is that the Senate delegation's trip hasn't really done much to address any of those issues one way or another. And I should also add that right now, of course, what you're seeing is a big problem for the Biden administration in terms of it looking like that their export control policy isn't working, that perhaps their China policy isn't nearly as strong or as fine-tuned as it appeared earlier this year. So lots of other issues, naturally, that markets are now increasingly trying to wrap their heads around.
Shahzad, what about the fact, though, that Xi Jinping did make time for Senator Schumer, met with him, lots of talk about whether or not he's going to be sitting down with President Biden at APEC next month. Does this signal that maybe that meeting is more likely?
I think that is something that the White House is coordinating directly. Quite frankly, the senator's office doesn't have any remit on setting up that meeting. I think it looks like it's going to go through. It's part of the current administration's larger effort. They've done a series of high-profile meetings going into China. Part of this is, of course, China is finally open for business. You can actually travel to China and meet with your counterparts, which is also the reason behind this flurry of activities. The real question now becomes, what are the topics that can be discussed? And, is this just to keep the lines of communication open so that there is no misunderstanding of intentions, which is very, very important? Because if we're talking about resolution on certain issues or striking any deals, well, quite frankly, there's nothing on the table that the two sides today can sit across from each other and discuss.
Shahzad, how much more difficult does this make in any business trying to make sure that there is, and we've heard this cited multiple times over the course of this year on earnings calls, the amount of international conflict, and back then it was just Russia-Ukraine, which, by the way, still goes on in the backdrop. So what type of kind of multiplier does this add on for businesses trying to navigate a fractured international equation?
Yeah, look, I think businesses would tell you that our real concern today isn't what's happening in China, even though, empirically that's not true. But they're certainly very concerned about policy as it has been formulated in DC. And they're trying to, consistently push back, of course, any hardening of policy vis-a-vis China, whether it's on things like export controls, whether it's potentially new investigations and additional tariffs, and so forth. But the reality remains that businesses have to get very, very sharp about managing policy risk, about managing political risk more broadly. And they have to get very, very serious about how they think about risk in China as well as Washington, D.C. Because at times over the last, I would say, and at this point, going on to almost 8 years, they have been caught off guard. They have sort of been sitting ducks in both countries. And that's been bad for the bottom line. And it just business as usual is not going to work anymore.
So, Shehzad, putting the geopolitical relationship between the U.S. and China aside for a minute, I'm curious because you're looking at the data right now. What's your assessment of China's economy heading into the holiday season, and really also what that signals just about some of the global demand that we could see or lack thereof when we talk about the fact that the recovery that we're waiting to see in China is certainly taking much longer than we had initially anticipated?
Yeah, Shauna, the first thing I think it does is we just went through a late summer, August into September period where everybody told us that, China was collapsing and the sky was falling. And the first thing this really does is once again underscore that China's economy is nowhere near being on the verge of collapse. Number two, what it does is it actually shows you that whereas there's serious amounts of weakness and a serious concern in the property market, parts of the economy are actually doing okay when it comes to consumer spending on travel and so forth. You're actually seeing that part of the economy doing all right. You also see that the manufacturing sector has held on far better than anybody was claiming, when the PMIs, for example, were in multi-month contractions. So the economic picture is nuanced. It is not altogether bad. It is certainly not stellar the way it was expected to be. It's rather boring, but there is a parts of the economy continue to recover. I think China probably hits its 5% growth target, but markets need to now figure out how do you navigate an economy that no longer grows at this exponential pace that you were used to, and you don't get the stimulus that you want, but at the same time, it's not altogether bad. You have to pick winners and losers now, and it takes a lot more work because the picture is a lot more nuanced.
All right, Shehzad, always a pleasure to get your insight and perspective on everything. Shehzad Qazi, China Beige Book International Managing Director. Good to see you this morning. Thanks. All your markets action ahead, live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance. We're live from the Nasdaq market site in Times Square with all the devastating news out of the Middle East this weekend. It feels like McCarthy's ousting is a distant memory, but there is still no House Speaker filling his vacancy. And with Israel declaring war on Hamas after a surprise attack, House chaos will further delay aid to the country, and pressure is mounting. Over the weekend, the Biden administration saying they are moving quickly to deliver weapons and resources to Israel that were already a part of existing contracts. But questions now on how Congress could approve a larger aid package remain. Joining us now with what's on his radar, we've got Yahoo Finance reporter Rick Newman. Hey, Rick.
Hi, guys. So the analysis inside the Beltway in the aftermath of the outbreak of war in Israel is that this will be kind of a forcing function that gets the House Republicans to get their act together, elect a speaker so that the House of Representatives and therefore the rest of Congress can actually conduct business in case they might have to do something serious, given that there's now a new war in the world that will at least indirectly affect the United States. So Republicans are going to reconvene this week. There could be a vote as early as Wednesday, although it sounds like it might be later in the week. And this is a test. So can the Republicans, can the adults in the Republican Party, assuming there are some, can they assert control and say, look, we can't be infighting among ourselves indefinitely while serious issues are going on elsewhere in the world? If they cannot get themselves organized, I mean, it just continues to it would continue to paint the party as a bunch of amateurs not ready for prime time. That would benefit Democrats, obviously, and I think Republicans know that. So at least some Republicans know that. So we may get this whole issue resolved by the end of the week. And then we can figure out what comes next. But if we can actually get a functioning House of Representatives, the very first order of business is going to start working on all those funding bills, because funding for the government expires on November 17th. And there could come a point in which there is a need to appropriate new weaponry or new money or something along those lines for Israel. So the House needs to get itself in a position to be able to do that, which it currently is not.
Rick, when we talk about future funding, potentially here, a funding package for Israel, is this something that could potentially make the odds of a government shutdown less likely, that lawmakers are going to come to an agreement and we won't be facing a shutdown on November 17th?
Who knows, Shauna? I mean, I think this whole thing, even if we get a speaker, and of course it depends who the speaker is, and it also depends whether it's the same arrangement as last time, where all it takes is one unhappy Republican who can force a vote to fire the speaker. That's what happened to Kevin McCarthy. I think the one thing that is changing is that there is now a new reason for people in Washington to be serious, which is the war in Israel. And, you know, we're not going to send troops, U.S. troops to Israel, but we are a staunch ally of Israel. Israel has many allies in both political parties on Capitol Hill, and there will be strong support for Israel. So Republicans need to be part of the grown-up activity here instead of just having this food fight among themselves. So almost everybody in Washington recognizes that. I think the question is whether that will be enough to force some kind of some Republicans to coalesce and start to field a team. Once we know that, we will have a better idea about what happens in November and onward after that.
Hopefully we do see some progress soon. All right, Rick, thanks so much.
Bye, guys.
Keep right here on Yahoo Finance. We got all your market action ahead live from the Nasdaq market site. We'll be right back.
Goldman Sachs analysts and top executives from across the technology, media, and telecoms landscape are gathered in San Francisco for its annual Communacopia and Technology Conference.
Nextdoor is doing some pretty cool things on the AI front with our assistant and also with Vitality. For us, it actually starts to unleash unique data. We are the local knowledge graph, so I think the value of what we do starts to really shine forth. We're the only platform where you're finding out what's going on around you locally in real time. So with that data, we can do things like on the platform, help a neighbor compose a post in a way that is more engaging. So the assistant or the AI actually does that for you.
There's lots of interesting discussion we can have around AI. So we announced just this morning, Zoom AI Companion, which is our answer to how generative AI is going to be included in our platform. And there's all kinds of really cool features that come with that for our paid subscribers. There are things like Chat Compose, if you're in a chat thread and you want to be able to respond to that. There are things like meeting summaries, which after the fact help categorize and capture not only what happened in the meeting, but also the true sentiment.
I think any creative would admit that AI is transformative to how they think about and how they concept new ideas. So I think it's going to be very exciting. It's still early innings, and we got to figure out how to do it right.
There's a lot of hype in our industry. I think this may be underhyped. I think it impacts things at so many levels. It impacts how we interact with computers and how they seem personal. It generates how art and media is created. It's really a breakthrough in computer science, and it impacts not only the products, but it impacts how software is created.
There certainly needs to be a lot of debate about AI and journalism. 57% of newsroom jobs in the United States have been lost. We're facing another wave, in this case a tsunami potentially of job losses, because of the impact of AI. And these are not just jobs lost, but it's insight lost. It's important that all media companies understand the impact, but also it's incumbent on the big AI players to understand their impact.
We launched Intuit Assist. And Intuit Assist is really a personalized, intelligent assistant in your pocket. It's also powered by AI-driven human experts so that when you are getting assistance from Intuit Assist, if you ever need to talk to an expert, no matter what it is that you're doing, you're able to do that. So there's always a gateway to help.
AI is going to change this whole industry completely. And so we're thinking a lot about how do we use AI to match people a lot better and to support the conversations that are happening. I think conversational AI is also a big opportunity because people do produce all these messages. So helping them craft those messages, make it easier to communicate, I think is something people will really appreciate as well.
The AI revolution is here, and the future as we know it is getting a high-tech upgrade. And Google, Microsoft, and Apple are leading the charge with a new wave of advancements. From digital assistants to photo editing, AI is transforming the next generation of products.
What we're seeing, I would say, is a once-in-a-generation shift in AI adoption. The transition from the phone you have in your pocket to what these companies are cooking up is as monumental as buying your first smartphone app. All of this of course, is part of an effort to boost device sales to make up for the severe COVID hangover that crushed hardware revenue for several quarters. Let's start with Google. The company is known for adding AI to its smartphones, but it's ramping things up big time by making the Pixel 8 and the Pixel 8 Pro the first phones to run Google's foundational generative AI models on device. That means the stuff that powers its AI in the cloud is coming to your pocket. That's not all Google's Assistant can do now. The device can answer phone calls with an uncannily human-sounding voice and pull up context-sensitive canned responses based on what the caller says. You can then use those to have the assistant reply on your behalf. Then there's Magic Editor, which lets you completely change your photos using AI. Got a pic of you shooting baskets and want to make it look like you're dunking like an NBA star? Magic Editor can do that. Microsoft, meanwhile, is bringing its AI-based Copilot to Windows, Outlook, and Microsoft 365. The AI software can summarize meetings, translate websites, write emails, and more. For now, it will do all of this from different Copilot apps, but eventually, Microsoft says it will roll all of this into one app to create a kind of high-tech digital assistant for all your needs. Finally, there's Apple, which is launching its new Double Tap feature for the Apple Watch. Double Tap uses machine learning algorithms to determine when you move your wrist and pinch your fingers to help you read and reply to texts or pause and unpause music with one hand. Predictive text is far more accurate across the board, and live voicemail transcribes voicemails as people leave them so you can see if the person calling has something pressing to tell you. Taken together, the moves are a clear sign that AI is becoming less of a concept and more of a concrete product you'll use every day. And this is crucial to investors in those companies who are betting on AI's future. We're still in the early stages of the AI takeover, but it's easy to see it isn't going away anytime soon. Our Investor's Guide is coming up with two key analysts on Wall Street to tell us how investors should navigate this space. But before we get there, let's talk about one company that's already doing this. Microsoft is bringing its AI-based Copilot to Windows, Outlook, and Microsoft 365. The AI software summarizes meetings, translates websites, and writes emails, and more. I spoke with Yusuf Mehdi, Microsoft Corporate Vice President, for more on this new innovation.
In this age of AI and Copilots, like you talked about, reimagining everything that we do, Windows, M365, Bing, Edge, and our Surface devices, and having those all really be AI first. And the second thing was the announcement of Copilot, which is the one single AI companion that you can use every day to ask questions, to create, and to take action.
So I guess, where is Copilot going to live? I know it's in Windows 11, it's in Bing, it's in Edge, Outlook. Where is it going to live for the average person? When are you going to interact with it?
Yeah. So the way to think about it is we want it to be everywhere that you need it. Right. So your everyday Copilot, it can be like one click and it's up as an assistant, but it's also going to be smart, so it'll pop up when you need it. So for example, if you go to highlight some text or you have a photo, Copilot will pop up and say, hey, do you need me to do something with this? Do you want me to copy it in? Do you want to summarize it? And we'll get smarter as the thing goes. So we'll know what actions to take on something that you select.
So I guess, is it, there was a discussion of this new age of computing. I think Satya had said that, we had gone from the PC to the CP for Copilot. How does this change then computing for consumers and the enterprise?
Yeah, the way this changes is very profound. Is in the past you might say, oh, I got to boot up my operating system or do some things in my operating system, then I do some things in my apps, and then maybe I do some in the browser. Now, over time, you're going to end up going just to your Copilot. We think more and more that'll be the primary way that you will interface with all of these things, and it will be smart enough to know, hey, do I need something from this app? Do I need something from the internet? Do I need something from the operating system?
I guess when you look at this, you have Windows, you have the Copilot in there, you have Microsoft 365, you have the Copilot in there. When it comes to privacy and security, what can users expect?
Yeah, so we obviously put privacy and security at the highest order of importance for us. So a couple things people can expect. One is that we will protect your user identity and your privacy. We don't associate any of that data with you when it comes to doing AI. We will provide new capabilities like we demonstrated today, like the notion of personalized answers that are based on your chat history. And then you can get more tailored answers. So for example, if you are like me and you like golden retrievers and the Seahawks and you say, what's going on this weekend, we can give you better answers in your search results. But if you don't want that, you can turn it off. And then lastly, if you work at a company and you have confidential information, you can use a feature that we call Bing Chat Enterprise or Microsoft 365 Copilot. And then we will keep all that data private to your company. It doesn't ever go to the AI models. It doesn't train the AI model so no human looks at it.
And we've been kind of having this discussion about AI since February.
Yeah.
When Bing and Edge launched, it was the big unveil, getting the Chat GPT technology in there as well. I guess what is the uptake been like from Microsoft so far? How are people receiving it? How are enterprise customers receiving it? Because the announcement for 365 pricing for $30 per person was massive for Microsoft. So I guess what has the uptake been so far?
Yeah. So what I would say is two things. One is I'd say it's been phenomenal in terms of usage. Like we have a waiting list for my M365 that has a $30 per month per user adder, and people are lined up for it because they see the value, they want the value. We have millions of people using Bing Chat. We've had over 1 billion chats and 1 billion images created. And at the same time, I would say, look, we're on the early days of the adoption cycle. So think about when the PC first came out, or the iPhone first came out, or the internet first came out. There were some use cases. There were the early adopters that knew how to do it and used it, and then little by little, more and more people come on. We're there now, although it's going much faster than those in terms of adoption. And so it's exciting.
And, just as a final, on stage you kind of said that it reminded you of the 90s.
Yeah.
With kind of the explosion of new softwares, new types of computing. I guess, is this the future of the desktop, the PC? Like, is it going to be something where, I have my PC, I have my desktop, and I have my Copilot here, or is it going to be where, you're on Copilot and you're going to eventually kind of work through that primarily?
That's a good one. We're going to find out is the honest answer. But the way I think about it is more and more and more, you'll just have your AI assistant that you will probably interact with for a big part of how you use your PC. So, you'll wake up, you'll say, hey, summarize my emails of the day, tell me what's hot, tell me what I got to go take action on. Then you might say, tell me the news of the day. I need to create an email for my daughter. I need to get some things done. Hey, play some music for me. And so all that will be done through the Copilot. You won't be necessarily going start button, mouse clicking. You'll be doing that.
And that was Youssef Mehdi, Microsoft Corporate Vice President. Well, for much more on this discussion as companies battle over the next big thing in AI, where should you be putting your money? Let's bring in Tom Forte, who is the D.A. Davidson Managing Director and Senior Research Analyst, and Rohit Kulkarni, who is the Roth MKM Managing Director, alongside Yahoo Finance's tech editor, Dan Halley, here for the conversation. Great to have you all here for this discussion here. Tom, I want to go to you first. As we think about and evaluate AI, what is the top idea or top thing that investors should be keeping track of to define who are going to be the winners and losers in this AI trade?
Sure. So when I think about companies that have an opportunity to exploit artificial intelligence, I put Amazon at the top of the list. And if I was to liken what's going on with AI with the gold rush from many, many years ago, Amazon essentially selling the picks and shovels to the extent that they're enabling other enterprises to leverage AI with their cloud computing AWS effort, and then are essentially selling the gold to the extent that they're using AI at the company level to improve recommendations to consumers to drive e-commerce sales, and then over time to increase the level of automation at their fulfillment centers, which will help them manage labor expenses. So I'm looking for opportunities for companies to leverage AI. I think Amazon's an obvious choice there.
Tom, this is Dan. What does that mean for Amazon that they're working on these kind of AI-based chips? Does that mean that they'll eventually be able to sell them to competing firms, or maybe not competing firms, but partners? Will this kind of help them wean themselves off a reliance on NVIDIA chips? What does it mean that they're working on them? And I guess what does that mean for the broader industry when we see more of these companies, Microsoft is doing this as well, kind of diving into the area of AI chips?
So the chip shortage in AI is affecting everyone, including Amazon. The way that I think about it is it's an opportunity for them to alleviate the chip shortage, but also a way for Amazon to do things less expensively. So think of the vertical integration by having the AI chips created by Amazon. I think that's important from both the supply chain standpoint to the extent that you're seeing, a bottleneck. People can't get enough chips to advance their AI-related efforts. And then also from a cost standpoint, to the extent that I think it'll enable Amazon to do it at a lower expense rate.
Rohit, let's get you into the conversation here when we're talking about investment opportunities within the space. What do you think is the top play in AI right now?
Hey, thanks for having me. I think Google is kind of the godfather of AI, in my opinion. All that we are hearing from anybody who's doing anything on AI right now, that came out of Google many years back. Google has been doing large language models before people spelled out large language models, to be honest. And I think Google has various different ways of kind of monetizing AI and benefiting from AI over many years to come, in my opinion. For example, they have these chips similar to Amazon. Probably they are doing a job that's probably better than Amazon, maybe comparable. And I think Google has been training their models on their own chips longer than anybody else in the industry. Probably NVIDIA is the only one that comes closer. And then you stack up various different blocks of the tech stack over the next 3, 4, 5 years. I think Google has those blocks built out, and they're applying them internally probably better than many other companies. So I think if I had to pick one of the large mega caps that are kind of under the radar right now, NVIDIA is obviously above the radar. Google is under the radar, and that's the one I feel they have the capabilities, they have the history, they have the innovation, and they're obviously, in my opinion, the godfather of AI, no matter which way you cut it.
Rohit, I want to ask what that kind of means for the relationship between Google and Microsoft. Google, as you said, they're the reason why generative AI exists, essentially because of the way they've developed models over time, these transformation models. So I guess with Microsoft going forward with OpenAI, really, just piling AI into everything they have to offer, seemingly ahead of Google, where does that leave Google then? They are the godfather of this, but it just feels as though they're not rolling out the technology to their enterprise consumers or regular consumers as fast as Microsoft can.
I agree, as in they are probably, given the current stage of where each of these mega caps have started to roll out features or AI-enabled products into their enterprise and consumer user bases. Google is probably a little bit behind Microsoft. That's what it makes that much more attractive, given their track record. They have gone through evolutions of developing consumer use cases unlike many others. So probably search, which is the gateway to internet, and Google controls that to a large degree. That has the potential of highest disruption and the highest benefit both ways. And that's where I feel in the next, call it 6 to 12 months, we're going to see innovations in search, followed by various different innovations in how we consume video, how video gets created, how audio gets created, all those various different innovations that we are going to see come out of Google. That should, given they're behind the curve a bit, that makes value creation that much more imminent.
Now, Tom, you also have an artificial intelligence wildcard, and from way downtown here. So tell us about this wildcard and why investors should be keeping this on their radar.
Sure. So a lot of people look at Wayfair and they think about home e-commerce products. I look at Wayfair and think of it as a technology company focused on home e-commerce products. So what I like is they have practical use cases for artificial intelligence. One is to enhance the customer service to the extent that they can use generative AI to improve the quality of the responses that the human customer service agents give to customers at Wayfair. The second is to the extent that they have a very large catalog on millions of products on their platform, and they can leverage artificial intelligence to enable consumers to take pictures They can take a picture of a bar stool. They can find out if Wayfair sells that bar stool or similar ones, things of that nature. So I like Wayfair as a technology company that's thoughtfully using artificial intelligence, and that's my wildcard pick.
I guess, how does that line up with something you would see from Amazon, right? Or even Google? Google allows you to search for things, use Google Lens, it uses AI. You can go into Google Shopping and get a chair, a couch, a coffee table, whatever. Same thing on Amazon with the kind of way you were describing placing something virtually in your home. How does that then line up with those? I guess, is it going to be able to keep up with what a powerhouse like Google or Amazon have to offer?
The answer, I believe, is yes, to the extent that they have the Castlegate warehouse system at Wayfair, and that enables them to have the logistics element, get the product to the consumer. When you think about Amazon versus Wayfair, Amazon also has fulfillment centers, but a lot of their fulfillment centers are built for smaller items, not bulkier furniture type things of that nature. And I think Google has wonderful technology, but would require a third party when it came to logistics to get the product to the consumer. So I think that logistics advantage for Wayfair is what helps them versus Amazon, which is built for smaller items, not bigger items like furniture, and helps them versus Google, which is dependent on a third party to get the product to the consumer ultimately.
Rohit, when we talk about the growth opportunity here for AI, the fact that it obviously is a massive priority here for so many of these tech giants, how important do you think, or I guess how critical do you think the M&A factor is going to be? Because we certainly have seen a growing appetite here from some of the larger firms buying up some of the smaller startup firms that are making inroads within this space. Is this something that you see trending to the upside or an uptick in activity over the next several quarters?
M&A would definitely be something that larger companies would be exploring. Again, I feel right now private company valuations, AI native private companies are experiencing a tremendous uptick in private capital that's leading to their valuations going out of control. So I feel there is going to be greater appetite for M&A, but beyond the current hype cycle, beyond the current phase that we are in, perhaps we can talk in 6 months. That's when we should see some extra M&A once we are at a point where the economic models, the cost structure, the adoption curve, all these things start to flow in tandem, where we have a new steady state and a new understanding of how the next 2 to 4 years are going to unfold. Right now, we see them in a lull period where a lot of enterprises want to do AI, want to adopt AI, but they are unsure about the privacy, the data security, the various different hallucination-related issues, and even the cost structure of these AI models. So once they start to stabilize, they will stabilize, perhaps in the next 3, 6, 9 months, we should start them to kind of tinker around M&A to accelerate that adoption curve. So yes, yes would be the answer. Just wait for 6 months.
Rohit, I just want to ask you, outside of the chip space, we'll just leave that on its own. Mm-hmm. On the software side of things with AI, who's the leader? I mean, we talk about Google being the godfather. Amazon's obviously been using AI for years. So has Microsoft, although they had to go out and get OpenAI to really kind of compete directly in this space. Who is the leader as far as the software goes right now?
In my opinion, like if you look across kind of oversimplifying, but horizontal software versus vertical software, there are various different productivity tools going horizontally across the various functions and various industries. In my opinion, if you look at a company like a Salesforce, which is creating horizontal tools and improving productivity across every step of the marketing and advertising funnel, a company like that is something that should increase kind of the value prop they have to their existing user base of customers. And at the end of the day, I feel if you have distribution, if you have scale, smallest amount of productivity improvement in horizontal apps is going to lead to amplified impact on their customers. So that's where I would look around for the next leg of winners: horizontal software applications with large distribution workforces, and Salesforce is one that that comes to mind, because they are going to add these small, tiny little bells and whistles, and that is going to create an amplified impact. And come next year, we are going to see that happen.
Rohit Kulkarni and Tom Forte, thanks to both of you for giving us some insight on some of the best ways that you see to play AI. Thanks.
Thank you.
Thank you.
We've got all your market action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
We might be on Cornelia Street right now, but Taylor Swift is definitely not heartbroken. From a $5 billion tour to a new movie on the big screen, Taylor Swift is all anyone can talk about. And her superstardom is expanding beyond the Billboard charts and having an unheard impact on the U.S. economy. From increasing viewership for the NFL to getting blamed for inflation, the Taylor Swift economy isn't going out of style, and we have all the details for you right here on Yahoo Finance.
A crucial inflation print and the start of third quarter earnings is on investors' minds this week. Yahoo Finance's Josh Schaefer here to break down the busy week ahead. Josh, what's happening?
Yeah, Brad, we really do have a busy week here when you take a look at both economic data and the start of third quarter earnings season. I want to start first with that economic data, though. We can take a look at that calendar. You're going to see some key data points coming out of last week's jobs report. Remember, that jobs report came in a little bit hotter than expected. So then when you take a look at the report this week, the key thing I'm watching is that inflation print on Thursday, because of a lot of economists we've spoken with over the last couple of days that sort of understanding what Friday's hot jobs report meant means there is the potential for the soft landing still, right? When we talk about the economy doing well, job growth happening, but is that balanced with inflation continuing to come down? If you have inflation continuing to come down, we saw wages decrease in that Friday jobs report, the economy could still be in a very good position here. Now, of course, the downside to that and the potential risk for another Fed rate hike would be if we see inflation increase on Thursday or even just remain flat. We're expecting those prices to come down on a monthly basis just slightly. So we're looking for a little bit of a decrease in inflation on Thursday. Then we'll get consumer sentiment on Friday. And of course, always, I shouldn't have skipped over it on Wednesday, the FOMC meeting minutes. Always something interesting to watch. I'm sure there'll be a tidbit on Wednesday there that we're talking about.
And Josh, when we talk about everything that's on the radar right now, you mentioned it briefly off the top, but earnings clearly going to be a focus here. We're starting to hear from some of the larger banks at the end of the week. What are you going to be keeping a close eye on?
Yeah, Shauna. So Friday is sort of the kickoff of third quarter earnings season in earnest, if you will, with all of those financial companies you're going to see reporting there, all those banks. You got JP Morgan, Citigroup, Wells Fargo, PNC, BlackRock. And really what we're wondering there, what we always wonder from these banks, is what are they saying about the overall health of the U.S. economy and the consumer? And then also, how are they dealing with these higher for longer interest rates, right? How is that impacting what is going on within the financial system? Because that will tell us what will happen with the rest of the companies and some of the companies that were just on your screen moving forward. But on Tuesday, I'm really interested to hear what we hear from Pepsi this week, because Pepsi is one of the companies that has been listed recently by various different Wall Street research firms as a company that could see downside risk from Ozempic and different prescription weight loss drugs. If you take a look at Pepsi shares over the last 5 days, they're off about 5%. They're off nearly 10% in the last month. Coca-Cola shares have also been down. So I'm wondering if Pepsi earnings is going to be the start of us hearing about Ozempic for third quarter earnings. It's been a big story on the street thus far, and I'm curious if one of these analysts is going to start asking executives about it, and we hear a little bit more about what prescription weight loss drugs means for the food sector moving forward.
All right, Josh, a lot to keep tabs on there. Thanks for kicking off the week with a view at what we should be keeping our eye on. Thanks so much. Now let's get you the markets commentary of the day here. Goldman Sachs Chief Investment Officer David Kostin and his team believe margins for S&P 500 companies should contract moderately in 2023 and expand again through 2025. The investment banking giant reiterating its S&P 500 EPS estimate of $224 for 2023. Now, Kostin expects a forecast of $250 for 2025 here. And so that is perhaps one of the movements that we can keep an eye on here.
It will be, and Brad, we're also keeping a close eye on what Goldman Sachs' Jan Hatzius is saying. Now, he sees a risk here from the higher for longer regime. Now, in his most recent note out today, the economist is saying that the main implication of the further tightening in financial conditions is that the drag on GDP growth is going to last longer. And talking about exactly what that means, he's now expecting roughly a 0.5 percentage point hit to growth over the next year, saying that's still too small to threaten a recession, but he's highlighting some of the issues, obviously, that we know are on investors' radar when we're talking about this higher for longer environment right now, what that means for the equity market and what that means here for potential returns over the coming quarters.
Yeah, higher for longer shows up in a few different ways, and as the Fed has continued to discuss and evaluate where that could show up in consumer confidence and think about a longer played out weight of the recession risk on a consumer here and where that would show up in everything from everyday purchases and perhaps a dumbing down or a dampening even more of some of those discretionary purchases, all the way up to the largest purchases that you need to get financed, whether that be vehicles, the Fed has talked about that, whether that be homes and continuing to see fracture in the housing market. Fed has discussed that. So all of these things considered, that higher for longer has longer term implications. But then at the same time, a lot of the economists that we've kind of discussed this matter with as well have kind of put in context for us, thinking 20 years back even, that even though this is higher for longer relative to where we were at before and what we were expecting and what we were hoping for in terms of a more rosy rate environment here. Remember, rates dropped dramatically. Why? Because of the GFC, the Great Financial Crisis thereafter, and some of the market moves made to then be able to stir or at least bring about even more of that consumer confidence and reemerge both in housing as well as even into some of those discretionary categories. Then later on, after that starts to be able to be hiked incrementally, then you have the COVID pandemic, which is a great reset at that point of some of the rate environment all the way back to zero. Amazing lending environment as well that had to take place, and for good reason, to make sure that the economy did have enough stimulus, did have enough that was still taking place from the consumer mindset. But now us getting back towards perhaps what we haven't seen in the latter part of 15 years at this point in time of a stabilized rate at this level or higher, that's something that consumers are going to, at least at this point, it seems from some of these economists, have to get used to.
Yeah, and Brad, to that point here, just the unique situation right now. I think that's also why we have forecasters almost all over the map, just in terms of what the next couple of quarters are going to look like. We're almost in an unprecedented time right now when we talk about that higher for longer, given where we are in the economic cycle, and also given the reaction that we've seen to these higher rates up until this point. Yeah. Certainly when we started the year, there were many calls for a recession by this time in the year. We have seen consumers remain resilient. They go out there, continue to spend, although their spending patterns have shifted. But we are certainly trying to figure out what exactly this higher for longer is. And still, though, even though we could be in this period for longer than we initially anticipated, many, and Jan being one of those people out there, still thinking that there's a possibility that we'll be able to avoid a recession.
Yeah.
We'll see.
Indeed. Well, we're about an hour into today's trading session. We've got some interesting activity that certainly has permeated throughout the markets, both internationally and here in the U.S. as we started trading. Yahoo Finance's own Jared Blickery tracking some of the S&P 500 sector movements as of right now. Jared?
Yes, not surprisingly, energy is the biggest outperformer. XLE up 3% in that large cap space, but industrials also getting a lot of love. We have Northrop Grumman, RTX, for instance, and Honeywell, some others that have enjoyed some price appreciation here. But for the most part, it is risk off. Even Meta was actually showing a little bit of love. And let me just flip over to the Nasdaq 100 page, and you can see this was a sea of red before. There's a little bit more green. But what's interesting to me is to plot the difference between the semiconductor space and the software space. Now here's semiconductors, everything in the red here. Mobileye, which is an Israeli chip company that was spun off from Intel last year, that stock is down about 6.4% over the last year, up 37%. But that stock under pressure today disproportionately, but not seeing any huge fallout. And when we compare that to the software sector in the U.S., we can see a few cybersecurity names are actually benefiting quite nicely from this international conflagration. But one thing I'd like to add is that when we have a geopolitical disruption like this, we tend to see mean reversion. So that if we spike up in certain markets, that tends to ameliorate over the coming days and weeks. Even when we saw the Russian invasion of Ukraine a couple years ago, the crude oil market, WTI spiked up to $130, but then it did come off of that. And if we're looking at a tight oil market right now, that's on the supply side, and I'm going to go to the futures markets right now, where we see crude oil is the biggest gainer at 4.5%, still well off of the highs that we recently had, about $94, $95 per barrel. A lot of traders were caught off guard by this rise, and so this little bit of a downdraft was actually a bit of a respite from that bullish action, but now we're seeing that pick up again. So even though I said these geopolitical events tend to get some mean reversion over time, we could still see elevated prices, and we don't know exactly how this is going to play out in all of the markets, especially given the fact that this is a bond market holiday. Lots of traders not here. We can look at the currency markets, we can look at the stock markets, but the fact is a lot of traders are just not in the room. So we're going to have to wait until tomorrow in the U.S. to get the full fallout from the situation. On the Wi-Fi Interactive here, I want to point out that some of the defense stocks that I've been talking about have been surging. Lockheed Martin up 6%, RTX up 3%, but these are stocks which have really flagged over the last couple months. You can see here's Lockheed Martin, just broke down in the month of September, month of October, and only now because of this bouncing back. But the reason I'm bringing this to your attention is I think a lot of these stocks are just short covering rallies that we're seeing right now. Here's General Electric, a stock that is up 68%, probably has a lower short interest in it, and so not really seeing that squeeze to the upside. That stock is down 1.2%. I think a lot of these moves are simply going to be reversed in the coming days, but if we see a pickup in the conflagration, then anything can happen. So suffice to say that we've seen a lot of disruptions in the market here, but we've also seen some pockets of strength.
All right, Jared, thanks so much for breaking all of that down. Certainly some trades that we will be keeping close track of here in the coming days. We've got all your market action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
Welcome back, everyone. We're live from the Nasdaq market site in New York City. Nelson Peltz's Trian Fund Management has increased its stake in Disney and is expected to request multiple board seats. That's according to sources closest to the matter. Now, this comes with the future of the entertainment company still unclear. Bob Iger steps down as CEO in 2026, and the question of his successor remains. For more on this, we've got William Cohen, journalist at Puck News. William, great to speak with you as always here. So, what's old is new again in the activist campaign from Trian, and all in the same year. So, what could play out differently this time?
Brad, I think this is a pretty unusual move for a hedge fund manager to come back to a stock that he had made money on earlier in the year, and basically given up his proxy fight. Don't forget, he launched a proxy fight and then abandoned it, thinking he pretty much got everything he wanted. Now he's back. And of course, what's different now is that the stock is down considerably, maybe to the lowest point in years since Nelson abandoned the effort in the spring. Of course, what he cares about most is making money, and he must think that there's an opportunity here for him to make money given how low the stock is. There are just a world of hurt at Disney these days, and it's potential that it's been oversold. Not clear, really, because they don't seem to be solving any of their problems. They seem to be, quote, working on all of their problems, but there's not much evidence of solving them. Maybe Nelson feels like this is an opportunity for him to rattle the cage again and make more money.
William, do you think this is going to speed up maybe some more cost-cutting measures by Iger, some more strategic review just in terms of what would make the most sense if they do, in fact, decide to spin off or sell parts of their business? Do you think that this activity here from Nelson Peltz, that's going to kind of speed up that timeline here in the short term?
His last foray at Disney got them to speed up. The cost-cutting measures got them to speed up. A board chairman change got them to do some things that they were going to do probably more slowly. Whether or not he can get them to, make additional changes, and he wants board seats. I think he feels like the board is ineffective. I'm not sure there's much to argue with there because they really haven't gotten the job done. Nelson has a way of getting what he wants, and so I have a feeling that there's a lot of things on the table here that just don't seem to be happening. What are they going to pay for Hulu? Should they spin off ESPN? Should they sell ABC and their additional linear TV businesses? A lot of moving parts here at Disney. Succession. And nothing seems to be happening. So maybe Nelson Peltz is thinking, I'm going to rattle this cage again. If I can get some board seats, then I can really make things happen. He got action last time when he launched a proxy fight. It's time to once again think about launching a proxy fight. There are dates when he has to potentially make known whether he wants to initiate a second proxy fight. What I also find very interesting is, of course, his latest 13F filing did not include this additional shares that he bought, and this is what we call a strategic leak over the weekend to the Wall Street Journal to make it known that he's back in the saddle again and ready to fight.
Which is particularly interesting as well here. I mean, does this, in all of the back and forth between Trian, Disney, and much of it just over the course of this year, but of course, relationships can go back far more than that. Does this perhaps elucidate any of the top contenders or the front runners that Trian would be happy with as the successor of Bob Iger?
Succession at Disney remains a big black hole. It's just not clear who's in the. I mean, that's obviously why they extended Iger's contract for another 2 years. He was only supposed to be there for 2 years. Then they extended him, or 18 months. Then they extended him an additional period of time to 2026. Given the stock performance, given the failure to actually, make the strategic moves that he's been talking about doing. It would not shock me, honestly, it would not shock me if Bob Iger stepped down or were removed before 2026. in favor of somebody who's actually getting things done. And Nelson Peltz could be a catalyst for that. I'm really worried at this point about the succession. I don't see anybody in place or that he's lining up to potentially succeed him. And he's also not getting the job done, I'm sorry to say. Iger 2 has not been the sequel that everybody was hoping it would be.
Okay. William, there's been lots of talk when we talk about Kevin Mayer, when we talk about Tom Stagg, some of the names here that have been thrown around as possible successors. Who do you think then, or maybe there's nobody that's on your list right now, of who could potentially succeed Bob Iger, whether he's forced to step down or whether he steps down at the end of his term?
Yeah, look, I think, Staggs and Mayer were sort of obvious candidates that Bob Iger, pushed out once upon a time. And now they've gone to Candle Entertainment, which is owned by Blackstone, and it's not doing particularly well. And they've been asked to be consultants to Iger for various sale processes. They should be focusing on Candle, not Disney. And so unless Iger is planning to buy Candle, which is a possibility, and get Staggs and Mayer back into the succession process at Disney, that relationship has to end. If I were Blackstone, I would be putting my foot down on that, and pronto. So who does that leave? It leaves people like Jimmy Pitaro, the head of ESPN. He's trying to thread this needle between getting ESPN to be a digital direct-to-consumer business. That is very, very dicey because they're losing subscribers, and now you want people to pay for ESPN, what they've been theoretically getting for free, or as part of their cable bundle. It's going to be a very difficult needle to thread. If he does it, he could find himself, I think, in the corner office. But that's at least a year plus away, and just the way Disney has not reacted properly, has not made the strategic moves that everybody has been expecting it to make, really raises questions in my mind about whether Iger is getting the job done. And maybe they have to go outside for somebody. That's also a difficult situation as well. I don't. It's all is flux at Disney right now, and who comes back into the mix, but none other than Nelson Peltz to really disrupt things all over again.
Well, it seems like all options are on the table. Again, Disney trading right around its 52-week low. William Cohen, always great to speak with you, Puck News journalist.
Thank you.
Well, we've got all your market action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance. Live from the Nasdaq market site in New York City. Well, healthcare has been one of the most talked about sectors in 2023, benefiting from increased innovation and the growth of AI, but also at risk from rising rates and fears of a prolonged economic slowdown. The health conference in Las Vegas boasting some high-profile delegates from the industry, from hospital groups all the way to startups. Now, Yahoo Finance's Anjali Kamlani spoke with Kroger Health President Colleen Lindholz. They discussed the company's notable push into the retail health space, as well as a topic that's front of mind for many in the industry, weight loss drugs. Let's take a listen.
The GLP-1s, they've been around since 2005. Not sure if you realize that or not, but the original Trulicity that came out a long time ago. For type 2 diabetes, they've been out quite a long time. But you know, with any drugs, there's side effects, and the side effect of the GLP-1s was actually a good side effect, in that it caused people to lose weight. Right. And so, you know, over the years, obviously, there's been many different other drugs come out. There's one pill form on the market right now. But what I can tell you is that with the injectables, there are some they're hard to use. They have storage requirements. So but they have been blockbuster. I have to say, they've been blockbuster for some people. And I have to say too that, like, even the people that I know that are on them, they're pretty much, when they're able to lose weight, like they've tried diets over the years that have been really tough, when they're able to lose weight and in a pretty fast amount of time, they start to feel really good about themselves. They start to really change their behavior overall. So we're studying that right now at Kroger, but I definitely, from knowing people that are on those drugs, it's they're blockbuster for them, especially if they've tried diets over the years, and more of like a kickstart in a new lifestyle.
So it's not necessarily that they're eating less. That's not necessarily what you think will be the case, or you're not sure yet. You're still looking at the data?
Yes, yeah, we're still looking at that. Okay. So the way the drug works overall, people are eating less, but I believe it just makes sense that people are going to trade up to fresh foods, things that are like better for them, because they're feeling good about themselves and they're feeling good about healthy overall.
Talk to me about on the pharmacy side, though. You're tracking that obviously as well, the increase in use there. Yes. I know there's a nationwide shortage. I know we've seen a lot of payers pull back on covering it. But what can you tell me about the impact you're seeing of the newer GLP-1s, at least, in the pharmacy side?
Yeah, so Wegovy, which was the one that was officially approved for weight loss, has really taken off, and it's really been in retail across the board. There has been some shortage in getting the medication, so we've had people that have been waiting on it, but for sure they've been blockbuster, and we've been filling a tremendous amount of the drugs since really the beginning of this year.
Talk to me about the clinics. I think not as many people necessarily associate that with the brand. There's been this huge push into retail health. We've seen CVS, we've seen Walgreens, we've seen Amazon, big moves in this space. You've been around for some time. Talk to me about the impact there. Do you feel like it's sort of a slow and steady pace that things have been growing at, or is there more to come?
Yeah, so our retail clinics, the Little Clinic, it's under the banner the Little Clinic. They've been around and a part of the Kroger family since 2010. So we've had them for quite some time. And it is very interesting how really healthcare is coming to the people these days versus people going to healthcare. So the great thing about our retail clinics is that they're open 7 days a week. You know, unlike when people can't get into their doctor's offices, late hours, that type of thing, we're open. We see a wide range of things in our clinics. We take care of a lot of acute issues, you know, people that get sick, strep throat, that type of thing, kids' physicals. And then we also take care of people with chronic disease. So because there's a shortage of primary care physicians in the United States, we act as a primary care physician for many different people. So we're really proud of really the depth and the breadth of what our nurse practitioners and our physician's assistants have been able to do in the community. And I think there's lots more to come, especially when you think about the country moving from a fee-for-service model to a value-based care model, and what will that mean? And we believe we're going to play a huge part, not only from our clinic side, but then from our pharmacy side in helping people live a healthier life.
I know that there's definitely a lot of focus also on the food side and food deserts as well. The social determinants of health has become a big phrase in the industry. Talk to me about some of the partnerships. I know Bayer is one of them. Some of these partnerships that you're helping, and whether or not you're able to gather data to measure the impact that you're having there.
Yeah, so when it comes to nutrition, we have been working for quite some time on our Food as Medicine platform. So have you seen anything or heard anything about our Food as Medicine platform?
Yes.
Yeah, so it's really, we define Food as Medicine as a dedicated, educated, and personalized approach to helping people enjoy food so that they can live a healthier life, and then we can prevent disease before it starts. What's awesome about our Food as Medicine platform, it is anchored by a nutrition scoring system called OptUp. So we've been working on this for years also. And to really combat what's going on in the country with food insecurity, we call it nutrition insecurity, we've got to have a system to be able to measure food. And so we've been working on that with a bunch of different partners to really bring transparency and really simplify customers' healthier choices for them. So it's a system that's red, yellow, green, and really it helps people, if they want to opt up to something like in a commodity like cereal or like yogurt, it helps them make a better food choice to opt up to something that has more nutrition value. So we have multiple partners that we're working with, both on the health plan side to really prove out food as medicine, and on the pharmaceutical side to bring solutions and tools to the consumer that again makes it easier for them.
And so this is part of like an app that they would use?
So it's actually embedded in our Kroger app and in our Kroger website. We did develop it outside of the company a while back, and then we brought it inside of the company so it would be better for the customer experience overall.
So a lot of this going back to the point of really meeting the customers where they are, getting them into the system and making sure that you're able to monitor that. Do you see a long-term use for this kind of data in terms of what you're going to learn about the customers and how that translates to the use for the healthcare?
Yes, I do. So we really believe that the future of healthcare is personalized, not generalized. And when we talk about personalization, we can really take it to a new level, especially with the customer's permission. So I want to make sure that you know that we don't do anything with our data without the customer's permission. But when we're able to do that, it is amazing how we're able to tweak, whether it be diet or education or even on the pharmaceutical side, to what the patient's needs are. Like right now, if I would suddenly get diagnosed with something terrible like cancer, then my journey would change very quickly. And so what we're working on is that personalization really more than anybody ever has. And because Kroger has a data analytics wing of the company that's been studying customer behavior for a very long time, it's called 8451. If you've heard of that data analytics wing, we know customers very well. And again, with their permission, I think we're able to do things that really meets them where they are on their health journey in life.
All right, thanks so much to our own Anjali Kamlani, who is out there at the health conference in Las Vegas. Switching gears here, another major ticker that we're tracking here on the day. Shares of ARM, they're down over 8% since its public debut, but analysts feeling bullish on the semiconductor company. Here's what analysts have to say. Guggenheim and Citi both initiating coverage of the stock with a buy, plus JP Morgan joined in with an overweight rating here. So let's dive through what some of the companies are saying. I'll start with B of A here because they're saying that ARM is a unique beneficiary of rising semis design complexity here. They have a well, we mentioned the buy, but $65 is what they're looking towards right now, and that is compared to the current price that you're seeing on the screen, top right corner of about $54.63.
Yeah, Brad, going on a couple of the reasons why Bank of America is bullish here on ARM, just talking about the pricing power that the company has. They see it as a gainer in rising cloud, also automotive workloads. Also talks about, though, some of the risks here that is associated with ARM Holdings. And in that, they talk about the China exposure there, also Qualcomm litigation. They don't really mention this here as one of the headlines, but also the fact that SoftBank still owes just about 90% of the company. Certainly one of the risks that have been highlighted by many investors over the last several weeks, ever since ARM went public, just in terms of the volatility or what that could mean for shares going forward. But largely speaking, it has a pretty strong reception on the street. You mentioned the outperform rating, the buy rating there from Bank of America. Barclays also initiating coverage with an overweight rating. Citi has a buy rating on the stock, saying that in the more rapidly growing infrastructure space, long-awaited share gains in servers are evident. They also went on to say that ARM sales are growing faster and that warrants a premium valuation. Guggenheim also coming out with a buy rating as well. So we talk about the fact that maybe ARM hasn't gotten the reception here from investors as many had hoped in the first couple of weeks as a public company. But when you talk about some of the longer term duration and the longer term play for ARM, many on the street saying that it could be a good buy right now at these levels.
Yeah, JP Morgan also initiating coverage of ARM with an overweight rating, $70 price target here, talking about solid revenue visibility, margin earnings expansion, and predictable rising royalty rates and licensing agreements. Remember, ARM had kind of changed the revenue model that they were bringing to the public markets as well here versus, going after being able to get an average selling price or at least see some type of return because of royalties on a per chip basis. Now looking at it on the average selling price of the actual device that the chip is going to be going into instead now.
Yeah, certainly. Well, we're seeing some reaction on ARM shares right now. Just about an hour and a half into the day, you're looking at gains of just about 1%. Let's do a quick check of the markets here, talk about where things are 90 minutes into the trading day. We're still looking at some pressure across the board. All three of the major averages trading to the downside. When we talk about some of the movement that's bucking that downward trend, obviously we're taking a look at the energy markets and movement to the upside in the price of oil. Crude now up just over 4%. A lot of that being driven by the surprise attack from Hamas on Israel and what the broader implications of that could mean, given the fact that we are seeing some unrest geopolitically speaking and the risks that that could then pose to the larger market. So that's important to keep in mind. But again, all three of the major averages under pressure. You had the Nasdaq off just about 1%, the S&P off about 0.5%, the Dow off 134.
Yeah, consumer discretionary pulling up the caboose, energy leading the pack right now from a sector basis. Perspective here on the day.
Well, that does it for us today on Yahoo Finance. Keep it right here, though. We have Kiko Fujita and Rochelle Akufo taking you through the next hour.
Welcome to Yahoo Finance Live. It is 11 a.m. on the East Coast, 8 a.m. on the West. I'm Akiko Fujita, and here's what I'm watching at this hour. Israel issues a total siege of the Gaza Strip after fighters from Hamas launch a surprise attack on the nation. Up to 1,200 people have been killed. We're going to bring you the latest updates up ahead. GM's labor woes continue, this time in Canada. We're going to discuss what a looming strike deadline means for those plans. This as 4,000 more UAW workers go on strike, this time targeting Mack trucks. Plus, should the NFL buy ABC from Disney? We're going to speak with one analyst saying the deal would guarantee long-term success in the U.S. But first, let's take a look at the markets. We are seeing a down day to start the week here. The Dow down 115 points, the S&P 500 down 20, and the Nasdaq down 115. Of course, investors reacting to that surprise attack from Hamas on Israel over the weekend. A number of sectors we're watching today. Energy, a big one in focus. That sector getting a big lift on the back of oil prices spiking. Oil futures up more than 4%. And then, of course, a risk-off sentiment here giving a lift to gold in the market as well, with Treasury yields also up about 7 basis points looking at the 10-year and 30-year yield. We are beginning this hour, though, with the ongoing fight between Israel and Hamas. The Israeli defense minister has now ordered a complete siege of the Gaza Strip, more than 48 hours after Hamas launched an attack blocking all supplies of electricity, food, and fuel into Gaza. The death toll continues to rise, with 526 Palestinians and at least 700 Israelis killed since the conflict began 3 days ago. The U.S. State Department now confirms 9 Americans are among the dead. The fighting sending jitters across markets as investors turn risk off, storing money in safe haven assets like gold and the dollar. Oil prices also jumping amid fears that the conflict could spread to countries like Iran, halting oil supplies. Joining us now is Rad Al-Qadiri, Managing Director for Energy, Climate, and Resources at Eurasia Group. It's good to have you on today to get your perspective. We're seeing energy prices spike today. How much of this you think is just sort of a reaction in the markets, catching up to news of the weekend? How much of this is about a sustained increase to the upside?
It's good to be here. Look, I think this is a market reaction. This shows some of the sensitivities that the market has, really, when it comes to oil, when it comes to the Middle East. You've seen a bounce. It's not been a tremendous bounce, particularly when compared to the drop that you saw last week. Markets will worry. Markets are worried about escalation. They're worried about uncertainty. But if this signals anything, it is that they're being contained in terms of this worry. They'll keep a close eye on things. They'll wait to see any clear signals of direction. And in the meantime, you'll see some bouncing around, probably around this level.
There are, of course, several reports out there, or I should say a lot of speculation out there about whether, in fact, this was an attack that was planned beyond Hamas, potential involvement from Iran. Obviously, that would involve oil markets beyond what we're looking at right now. How much of the pricing right now you think has already factored in the fact that this is a conflict that could spread beyond Israel and Hamas?
I don't think that's been fully factored in at all. I think, as I say, what you're seeing is jitters. There have been reports, the Iranians have denied it. Other factions have denied that the Iranians were directly involved. Part of what we're seeing is noise, and part of what we're seeing is a fog of war. I mean, this was a devastating attack on Israel, and one that appears to have caught them completely by surprise. And I think for the Israeli government and the security establishment there's going to be a temptation to point fingers. Were we to see this conflict increase, then, it immediately brings about worries related to the Straits of Hormuz, whether Iran would operate there. Then you're talking about 20% of global flows. The kind of price impact that you would see on those worries would be huge. So really, this has been relatively contained and, worth looking at, I think, in a broader context of, a market that has been shaped and prices that have been shaped by a battle between futures and fundamentals, where futures have won out. Concerns about demand next year, concerns about the global economy next year. That's what brought us down from 97 to 84 last week. I say we've seen a slight bounce on that, but we've not even sort of recovered halfway towards where we were in late September. So I think, were there to be signs of a significant escalation, were there to be signs of direct confrontation between Israel and Iran, and were there to be real worries about the flows of oil, the spike is going to be much more significant.
Medium term, that demand picture that you just pointed to, you think that's going to continue to drive the price, or you think this conflict that has now played out day 3 here has injected a new risk into the energy patch?
I think it's injected a little bit of risk, but again, look at where prices were just 12 trading days ago and where we are right now. So I think this crisis has injected a certain amount of uncertainty. You're seeing that, and that's the sort of $3.50 jump that you saw this morning. But I think, fundamentally, this market is still being shaped by a longer term outlook for 2024. And, traders are going to keep a very close eye on the immediate events. So that's what will give you the little ticks at the bottom. But, getting to a higher price or recovering even, as I say, to where we were in late September, that's going to require the market sentiment to shift away from focusing on what they see as bearish indicators for next year.
And Rad, finally, you listed a number of potential risks stemming from this conflict as you see it from the energy patch. What is the biggest risk that you're going to be watching for in the days ahead?
Biggest risk is if you do start to get an escalation with Iran, if there's a chance of direct confrontation, Israeli strikes on Iran or something akin to that, because that then brings in the Straits of Hormuz to the equation. I think the Iranians will sit back and gleefully watch what's happening right now, because they will see it to their strategic benefit without actually having to do anything. Where the conflict has hit home, then the odds and the calculations are very different for Tehran. So that's the bit that, from an oil market perspective, something that will really disrupt supplies has to be the key thing.
Okay, we'll be keeping a close watch in the days ahead. Rad Al-Qadiri, Managing Director for Energy, Climate, and Resources at Eurasia Group. As always, appreciate your perspective.
Great to be here. Thank you.
Stocks are continuing to fall in reaction to the conflict in the Middle East as investors flock towards traditionally less risky spaces like gold and the dollar. Joining us now on this market reaction, Matt Miskin, John Hancock, Investment Management Co-Chief Investment Strategist, and Steen Jacobson, Saxo Bank Chief Investment Officer. Steen, let me start with you. How are you watching this conflict play out from a market's perspective?
Unlike the prior speaker, I don't have the luxury of sort of accepting a benign environment from here. I need to look at the portfolio across. I need to look at the advice that we are providing. And the market right now, as was just said, is looking at risk premium, which is negligible. I think it's big. I think, as someone has already coined it, I think it's the 9/11 of Israel. It's about an existential crisis. So I think the flight that we've seen this morning, and the biggest move I noticed this morning, is the short end of the U.S. interest rate curve. We have seen something like June contracts trading for 24 is up 12, 13 basis points in price, i.e. the rate is coming down. I think the immediate conclusion here is that Fed is done at a bare minimum. They're at a pause. At the same time, I think the reaction that we see in gold and in oil indicates that at a bare minimum, again, we are looking at higher volatility and less transparency in terms of both earnings, but also in terms of the direction of the global economy.
Steen, often with the geopolitics, we see a spike in reaction to the events. They don't necessarily last a long time. Do you get the sense that this is a little different given the history in the region?
I think it's different, but the argument that there is no risk premium is also based on the history. But you remember, there's two things that are very different. One is the framework of the global economy. When we had the crisis in 1973 and all the first intifada and the second intifada, we were in a global environment where we were cutting interest rate and inflation was not an issue. Now we do it with the highest amount of debt ever in history. We do it with high valuation of real estate. We do it with high valuation, even excessive valuation of some parts of the stock market. We see that the inequality in society is at an all-time high at the same time. This is now being, added to through first Ukraine and now this incident. So the fact we had Ukraine is the second factor. The first factor is that the global economy cannot sustain any kind of headwinds from here. It's already, in my opinion, moving into a Q4 that will see anemic growth, not only in the rest of the world, but also in the US.
And Matt, so much of the market action up until now has been driven by Fed policy and, of course, concerns around global economic conditions, particularly the slowdown we're seeing in China. Do the events that have played out over the last several days, does that change that base case for you at all?
It doesn't. And, it's just terrible and tragic. And geopolitical events like this are so hard as investors try to separate, the personal, emotional baggage and how terrible this is to the objective financial plan or way they're managing money overall. And to us, stepping back and thinking about a lot of the other speakers' points that I think are actually spot on as it relates to interest rates going up as fast as they have, as growth has likely hit a bit of a headwind here going into the fourth quarter. We do think that those trends in a late cycle environment are going to be what drives investment returns from here. We have earnings season coming up. But in overall positioning, we have been tilting to higher quality across equities and fixed income. The bond market has been a place of under pressure where bonds have really struggled. There are a lot of risks out there, and geopolitical risks were likely not fully factored into this market. And so in our view, bonds offer a lot of value where risks haven't been fully appreciated.
Yeah, Matt, given where we have seen bond yields move, we were just showing the 30-year yield hovering just below that 5% level. What has that meant in terms of your portfolio? Are you increasing exposure into fixed income given where yields are?
Yeah, so we have been more intermediate than long duration, but we've been higher quality. That has been a drag up until this point because the lowest credit quality parts of the bond market have been the best performer and the least liquid. In our view, we're looking at high quality bonds now that are yielding nearly 6%. And we're looking to lock that in terms of a yield and income stream for the years to come. We think that's going to be really competitive. And on a risk-adjusted basis, we believe that's going to provide positive Sharpe ratio and diversification benefits from other asset classes. So we continue to look at that favorably. To us, the yield is your best determinant of forward-looking return, and keep it simple. 6% looks really competitive cross asset right now.
Finally, Steen, in the previous segment, we were talking about oil moves that we've seen today, up about 4% in terms of oil futures. And yet this comes on the back of that rapid decline that we have seen on the back of concerns around demand. Do you still see this as just a temporary spike in reaction to the conflict that's playing out, or has the momentum shifted, you think, a bit?
I think technically oil did exactly what it's supposed to do. It had a retracement off the high. The world is still short energy. The world is still dealing with potentially now Iran falling out. Iran has been the main contributor to net growth in supply. The Suez Canal is potentially a transportation way that is very risky. No, there is no doubt in my mind that energy, as it has been over the last 2 years, is somewhere where you both in equity term, but also as a sort of insurance against the unfortunate events that happen to the world, needs to be long. You simply need to be overweight energy. We need it. We don't have it. And more importantly, the insecurity that is now applied to that delivery of energy has now increased significantly. This is even not talking about the potential end game, which is that someone like Russia could weaponize oil over the winter.
Yeah, certainly a lot of threads there, at least in the energy space. Matt Miskin and Steen Jacobson, it's good to have both of you on today. Appreciate the time. Well, we've got all your markets action straight ahead. Stay tuned. You are watching Yahoo Finance. We might be on Cornelia Street right now, but Taylor Swift is definitely not heartbroken. From a $5 billion tour to a new movie on the big screen, Taylor Swift is all anyone can talk about. And her superstardom is expanding beyond the Billboard charts and having an unheard impact on the U.S. economy. From increasing viewership for the NFL to getting blamed for inflation, the Taylor Swift economy isn't going out of style. And we have all the details for you right here on Yahoo Finance.
General Motors is facing the risk of another labor strike, even as it struggles to reach a deal with the UAW. 4,300 workers at its Canadian plants are threatening to walk off the job if they cannot reach a deal by midnight tonight. Let's bring in Yahoo Finance reporter Pras Subramanian for more on this. Pras, this is certainly not good timing for GM, but what are the key sticking points right now?
Yeah, well, it seems that Canada's Unifor is saying that GM is resisting some of the deal elements it struck with Ford Canada, right? So basically what happens is the unions will use their first deal, in this case with Ford, as a pattern agreement to use with the others, right? So in this case, Unifor was able to get a 25% wage increase, COLA protection, and cutting top pay wage progression time to 4 years for those workers. Now, Uniform says GM is resisting to budge on issues like that, including expanding benefits to GM's full-time temp workers, a universal health care allowance beyond what Canada's national system uses for retirees, and then also outlining future projects and hiring commitments. This is kind of a big deal, namely with new factories that and things that will build they'll build batteries and next-gen vehicles. Excuse me. So, like you said, if no deal reached tonight, potentially 4,300 GM workers will go on strike. So those are the sticking points right now as the deadline approaches.
And Pras, what's the very latest on the UAW strike? We now have an expansion into Mack trucks.
Right. So today, well, Mack trucks, their UAW workers there at Mack trucks rejected a deal that the two sides actually agreed upon by 73% no vote. Now, what happens here is that the actual UAW members, that the vote is the main important determinant as to whether the deal is going to happen, and they rejected this deal. UAW President Sean Fain said he's inspired to see UAW members holding Mack trucks out for a better deal. Conversely, Mack Trucks CEO Stephen Roy said he was surprised and disappointed by the rejection, claiming the truck maker had bargained in good faith with the UAW. So nonetheless, you see here that the UAWs have the members have the final say with any deal. And if they don't think it's good enough, they're going to show some resiliency, which I was surprised by. And I think even the union was surprised by as well.
Yeah, all the actions. Certainly keeping you busy, Pras. Pras Subramanian, as always, thanks so much for that.
Thanks.
Well, the electric vehicle industry is growing, but what does the future look like? According to a Cox Automotive Industry report, EVs made up 8% of sales in Q3. This comes as a majority of states in the country are still slow to adopt the cars. More on the future of EVs. Let's bring in Stephanie Valdez-Streety, Cox Automotive Director, Industry Insights. Good to talk to you today. You know, this comes at a time when we've kind of seen a slowdown in terms of EV adoption, the spike recently that we have seen in gas prices. How much of that has shifted sentiment?
I think we're starting to see, we have this wave of new models coming into the marketplace at different price points. So I think that's really helping. And for the first time, we have an oversupply of EVs. So manufacturers are cutting prices. You probably saw Tesla just last week cut the Model Y again. And so I think we're going to continue to see that. We have incentives that are really getting more robust. So I think consumer sentiment is changing in terms of the affordability. So I think that's really going to help. But as you can see on this chart, oh, go ahead.
Yeah, we're looking at EV price drops there, but you're talking about 8%, at least in market share. There's a really wide range when you're looking at how things are state by state. California, where I am, is near 25% for new cars, and yet you've got many other states that are lagging. Is it about price? Is it about infrastructure? What's holding some of these drivers back?
Yeah, I think that's a lot of different factors. As you mentioned, I think it's price, it's infrastructure. I think that whole range anxiety is really infrastructure anxiety. So I think that's part of it. I think the state incentives is another one. Education about the incentives. I think that's another factor that's really trying to promote EVs and really get consumers more aware about EVs. I think that's a difference in some of the states where we're seeing more adoption as well.
Specifically on price, you know, what do you think is the sweet spot for drivers that would convince them to switch over? The argument from the White House has been, you know, look, we've had these incentives for the IRA, $7,500 for new EVs. The market is likely to follow. It hasn't been quite as even. Is it about a price point that's in the 30,000 range? Is it 40,000? What are you finding?
Yeah, I think it's definitely that. We actually did a report last week, and it showed that 50% of the population consumers can only afford a $400 car payment. So affordability is critical. And I think we have the Inflation Reduction incentives, which I think are really good, but there's only, less than a dozen that are eligible. So I think as we start to see more affordable vehicles under that 40,000 price point, and then also more that are eligible for that EV credit's going to be important. The IRA is point of sale starting January. So I think that's also going to help because consumers are going to see that taken off at the point of purchase versus tax returns. So I think that's going to be another thing that we should watch to see how that helps with adoption going into the new year.
And Stephanie, you mentioned the price drops that we have seen given the oversupply in the market. Who's winning consumers over right now? We see Tesla at the top. They have been the leader. But what are some other companies that are making inroads?
Yeah, definitely Tesla's dominant. But if you look at just this last quarter, VW, the ID4 had over 10,000 sales. And I think if you think about that price point, and they are eligible for the IRA, so I think we're going to continue to see VW, Hyundai had record sales for the Ioniq. I think that's another player. And then we have a lot of, whether it's the Chevy, the Bolt's going to continue. The Nissan Ariya hasn't, initially it did sell a lot, but it's starting to pick up. So I think we're going to start to see more of the Nissan Ariya pick up over time. And then we have over 50 new vehicles coming in the next few years. So I think we're going to have different price points. So we're definitely going to see Volkswagen, Hyundai, Kia's has some new ones that are coming out. So I think that's really going to help from in terms of a price point, and we're going to see acceleration and start to see some of those brands chip more away at the Tesla share as well.
You mentioned infrastructure earlier, not necessarily range anxiety, but infrastructure anxiety. In your survey, what did you find that drivers specifically were concerned about? Is it accessibility to chargers? Is it the reliability? Is it the amount of time it takes because most are still level 2? I mean, how do you rank the concerns specifically on range and charging?
Yeah, I think we didn't do a study on terms of infrastructure, but what I found in my research is that it seems when you get to a charging station, the operability, the reliability is key. So I think it's going to be important not only to have infrastructure that's reliable, but also accessible, whether it's in rural areas, underserved communities. And I think one of the key things which we've been seeing in the media, I think Hyundai's the most recent OEM, is to have standardization. So I think from a consumer experience, it's so important that consumers want to be able to charge similar to what they do with an ICE vehicle. You go, you charge, it doesn't matter what type of EV you have. So I think that ability to have like a seamless, great user experience can be important with infrastructure. But key is that it's reliable, right? And that it's easy to pay, and that it's in areas along the corridors when you're doing a long road trip. Because I think as we start to see, the early adopters, now we're moving to that next phase of adoption. So for consumers that have to commute far, that's going to be critical to have infrastructure that's reliable and in places where they need to stop as well.
Yeah, reliability, a real concern. You can look at the map and see where the chargers are. It doesn't necessarily mean they're all working. Right. Does that point to Tesla's dominance, at least in the medium term, maybe even the long term, because they do have that infrastructure built out?
Right. And they're opening up, which I think is critical. The other thing is SAE is starting to do that standardization around the North American Charging Standard, the NACS, which Tesla has. So I think as we start to see more standardization, that's going to help. So as more OEMs start to apply that to their vehicles, we're going to see the standardization help with, I think, the consumer experience. The one thing that I always think about is we want reliability, especially with the NEVI program. That's metric of, I think, 97% operational. But I think the key is to make sure that we're able to consistently and reliably report on the operability and reliability of this infrastructure as well. So I think that's going to be key too.
Certainly key to reducing some frustrations for EV drivers. Stephanie Valdez-Tridi, Cox Automotive Director, Industry Insights. It's good to talk to you today. Appreciate you stopping by. Well, we've got all your markets action straight ahead. Stay tuned. You are watching Yahoo Finance.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now, I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story. What does all this mean for you?
Keep it tuned into Yahoo Finance.
Bank of America economists are nixing concerns about a housing crash like the one experienced in 2008. Instead, they say the market is more reminiscent of what played out 4 decades ago. Let's bring in Danny Romero, who has more on the latest warning coming out of B of A. Danny.
Akiko, Bank of America warned last week that their economists are feeling some type of eerie deja vu feeling, but not from the 2008 housing market, instead from the 1980s. Bank of America economists say that there are a few key similarities. Back in the 1980s, inflation was running high. CPI had hit 14.8% on an annual basis, leading to those years in the 1980s. And as a response, the Federal Reserve raised interest rates, which consequently caused mortgage rates to hover between 9% and 18% during that time frame. Also, it was a prime time for baby boomers to start purchasing some homes. Does that sound a little bit somewhat similar to what's going on now? And if we fast forward to today, inflation hit its highest level June of 2022. And the Federal Reserve recognized that inflation was a problem, so they increased interest rates, and consequently, mortgage rates have nearly doubled. Mortgage rates are now hovering over that 7%, hindering purchasing power for demand millennials right now. And there are still some similarities. Home prices have surged, demand has fallen, sales of existing homes has tanked. But the biggest difference between now and then is leverage. Mortgage debt to disposable income hit 65% in the second quarter of this year, compared to 45% in the 1980s. That's not something to really worry about, Bank of America economists have said, because households' balance sheets are still really, really strong and they're in very good shape. But looking ahead, Bank of America expects limited housing, high home prices, and labor shortages. And also, they still say that affordability will remain the biggest challenge looking ahead. And they even said, wrapping up, that there is potential turbulence looking ahead. Akiko?
Yeah, no relief on the horizon, at least for prospective buyers. Danny Romero, thanks so much for that. Well, earnings season set to kick off this week with JP Morgan, Wells Fargo, and Citigroup set to report third quarter earnings on Friday. Certainly going to be a lot of scrutiny surrounding some of the nation's biggest banks as they navigate one of the most challenging periods for their industry. Will big banks be able to catch a break this quarter? Let's bring in Scott Krisloff, the transcripts editor and founder of Avondale Asset Management. Scott, good to talk to you today. There's certainly going to be a lot of focus on loan loss provisions, for example, with some of these big banks, given how we have seen credit tightening. What are you expecting?
Yeah, I mean, I think we're looking at interest rate sensitive sectors across the board right now, with longer term interest rates rising, and trying to see the impact that rise in interest rates is having on them. So, the same sorts of dynamics that hit Silicon Valley Bank earlier this year as their longer duration securities portfolios were impacted by rising rates. We want to see how that's impacting other banks across the space as well. Obviously, the mortgage space is going to be heavily impacted by this. Mortgage volumes have fallen already significantly, but those are the types of things that we'll be looking for in earnings season as it starts up.
We have seen the water, so to speak, sort of a little calmer, at least when it comes to regional banks, since we saw the SVB collapse earlier this year. You talked about the interest rate sensitive spaces. I mean, these regional banks, medium-sized banks, certainly going to be in focus yet again. What's your sense right now in terms of how much more of a shakeup we're likely to see, given where rates are and where they're expected to remain?
Yeah, I mean, I'm not expecting any sort of continued financial crisis from especially these long duration asset securities portfolios at banks. But we do really want to look at the way that interest rates are impacting, for instance, loan demand at the banks, just for a broader sense of how it's impacting the economy. As rates go higher, obviously you mentioned mortgages are one place where now that we're above 7%, it makes housing less affordable. But there's a lot of other areas of the economy that are interest rate sensitive as well, dependent on credit, that will make their way into loan demand. It'll be interesting to see how that's impacting bank quarters through that lens.
The energy sector certainly also in focus as well. We've seen a bit of a swing here where we saw sort of this march towards $90 a barrel in oil, a significant pullback that we saw last week on the back of the demand picture. What are you watching in that particular space, especially with oil majors?
Yeah, I mean, I think energy is a critical part of the economy still today. It has been a critical part of the economy forever. Energy is fundamental to all economic productivity. And still today, even though we have made a transition to try to incorporate more renewable sources into our energy portfolios as a society, oil and fossil fuels are still critical to the way that we generate, again, economic productivity. And so especially as you're seeing conflict in the Middle East and you're seeing oil prices rise, as you're seeing an economy that is strong and relatively hot, the same sorts of lid that energy prices put on the economy in past cycles in the early 2000s and the 1970s, we want to be watching for the ways that rising oil prices are impacting economic activity again here today. And especially the way that supply and demand imbalances within the energy space, oil space specifically, could impact oil prices going forward.
Does that point to further upside if you talk about some of the names in the energy patch?
Yeah, well, I mean, I think what we've seen a lot of the energy CEOs talk about over the last many quarters is that there's been an underinvestment in new sources of supply for oil, especially as, again, from a policy standpoint, globally, we've tried to emphasize more renewable fuel sources. And so there's been an underinvestment in the supply side of oil. And I think that can certainly put upward pressure on oil prices, especially as demand comes back online as we've exited the COVID period.
Finally, Scott, really quickly, we always look to earnings as a good gauge to get a sense of the health of the consumer. We've heard a lot of commentary from some of these retailers, especially about the pullback in discretionary spending. What are you expecting on that front, especially as we look ahead to the holiday season?
Yeah, I mean, we're actually still seeing strength in the consumer. The consumer wants to spend and continues to spend. But for a while now, the last several quarters, we've seen a bifurcation in terms of spend and the health of the consumer, especially lower income consumers doing much worse than higher income consumers in terms of their level of spend. And that's sort of creeping out. And so I think that especially as COVID-era stimulus is finding its way out of the economy, has been spent down by consumers, and then you have continued inflation, high price levels, it puts a damper on the consumer's ability to spend and continue to have spending growth. And so we're looking for signs across the consumer space in terms of how the consumer is doing, and whether or not these forces are going to impact or soften the consumer in any way.
Scott Krisiloff, the transcripts editor and Avondale Asset Management founder. Good to talk to you today.
Thank you.
Well, all your markets action ahead. Stay tuned. You are watching Yahoo Finance. Well, the NFL, which has largely relied on the linear TV model for years, has begun shifting its ways in an effort to reach more viewers and appeal to more content bidders. But our next guest argues that in order to reach 100% of U.S. homes in the long term, the NFL should consider buying ABC from Disney. Laura Martin Needham and Company Senior Media and Internet Analyst is behind that note, and she joins us now. Laura, it's good to talk to you today. Before we get into that note, that I do want to ask you about news of day here. With these reports, Nelson Peltz is now pushing for additional seats on the Disney board. His Trian Fund, already one of the largest shareholders. What kind of pressure do you think this now puts on Disney?
Yeah, I think it puts a lot of pressure because I think Bob Iger historically has sort of came into a mess when he got here, and he bought Pixar and he bought Star Wars. He bought assets to sort of fix that. And I think for the next step, what we need to is to disentangle this conglomerate. And I think Nelson Peltz is going to be good for shareholders because, as you know, Disney just announced they're going to spend $60 billion over 10 years on the parks. And I think Bob Iger's vision is sort of more of a 5 to 10 year vision. And I think with rising interest rates, the discount rate says that shareholders want returns now or they don't want to be anywhere near the shares. And so we're hitting like 10-year lows in these shares. I think Nelson Peltz is going to try to disaggregate and sell off pieces much more aggressively, which will take better care of public shareholders in the near term.
Yeah, how do you think Disney responds to this pressure? To your point, we have seen the stock recently hit a 9-month low. I mean, there are a number of catalysts that analysts, including yourself, have pointed to that could push the stock to the upside. This particular push, though, for additional board seats, what does that mean in terms of how Disney views its asset?
Well, as you know, Bob Iger at Disney, and actually Bob Chapek too, has had a couple of these activists. And what they do is they typically listen to the guy, they send a letter saying they're going to do that, and then the activist sells the shares, goes away. So Third Point just has a piece, it's scheduled today. It's completely liquidated its Disney position. So that's my guess here. I don't even know if Nelson Peltz has to actually get board seats or he just has to threaten a war. And then maybe they listen to him more intently and they try to execute it on their own time frame. So I think he will be heard. And he owns enough that I don't even know if he actually needs to actually get board seats to actually get something done here and make money on his investment. We'll see. But worst case, yeah, you'll have an activist in the boardroom who will be much more short-term focused than anyone currently on the board.
Laura, let's talk about your note. You've certainly got a lot of people talking by calling for the NFL to maybe pursue ABC completely or outright. Walk me through your thesis here.
Sure. So my thesis is that the current NFL contracts are all with like ABC, NBC, Fox, Amazon, and YouTube video are all 2032. So the NFL is sitting around fiddling while Rome burns because they figure, hey, we've got payments through 2032. It's 9 years from now. What's to worry about? And we're making 2 points. A, in 2032, there's only going to be one bidder for the next set of NFL rights, and that's going to be Amazon, because all these other companies will either be too small or too global to care about the NFL, because the NFL programming doesn't, travel well offshore. So if they're only going to have one bidder, suddenly their team values aren't going to go up from the $4 billion, they are today, past 2032. And in theory, they want a league post 2032. So they need to figure out who they can keep alive to have alternate bidders, to have a bidding war in 2032. And that means they need to they need to not stand by while the linear TV ecosystem dies, because NFL is the primary beneficiary of all those payments, as is the MLB and the NBA, et cetera. So they need to get more involved when, like Disney Charter, are threatening to actually unravel the linear TV ecosystem before 2032. They need to be more involved. They need to take a stronger hand in making sure that linear TV survives, or they're not going to have alternate bidders in 2032, and they're not going to have team values, because their team values come from broadcast TV license fees, essentially. So that's our one thing. The thing about what CBS found, which was a broadcaster, when it launched CBS All Access and it had access directly into homes, they had a lot more negotiating leverage with their other distributors. My issue is these guys, meaning the NFL, should buy ABC and its affiliates. That way it has guaranteed reach forever of 100 million homes. And usually these broadcasters like ABC have 45% profit margins. So it would give them a different business, a distribution business. Content and distribution are only valuable together. I don't care how good your NFL content is. You can't get it distributed because everyone's gone bankrupt or can't afford your rights. It's worthless. So I'm saying buy your own distribution, backward integrate, and distribute to everybody in America.
From the Disney perspective, certainly looking for the price tag that they can command in any kind of acquisition of ABC. How much negotiating leverage do you think they have as it stands currently?
So they don't have to sell, right? It makes, like I said, 45% profit margin. So they got a lot of current free cash flow to service their debt. So it would have to sell at a higher multiple than Disney sells at. And Bob Iger said in Aspen that he wanted to sell the ABC broadcast station. So, and I think he's wanted to do that for a decade. So I think Bob Iger is perfectly willing to sell the ABC owned and operated stations that Disney owns. And I think the NFL is a buyer that nobody's talking about. I think it's an interesting idea for them.
Laura, as you pointed out, just within football, NFL, we're talking about a number of shifts that's played around because of the streaming space. When you look at the sports landscape as a whole, I mean, what does this look like 10 years from now, let's say, just given how many shifts that are happening in the landscape?
Well, I think all of these sports rights fees have been able to go up. And even in college, we're getting movement based on the broadcast fees. These broadcast fees are going to all collapse if the linear TV ecosystem doesn't survive, because the linear TV ecosystem, as you know, streaming, which is the alternative, is lower cost and is all losing money. So none of them could afford to pay these rights fees that linear TV has been paying in the past. So really, for these leagues to get renewals that are higher than the contract they're currently in, linear TV needs to survive. And I think all these leagues are standing by and just not doing anything because they're under contract, but they're not thinking about what happens when the contract ends. We're having this issue right now with WWE, where nobody wants to buy their next set of rights. And the RSNs, because Bally's Diamond Sports went bankrupt. So it's unclear to me that these sports leagues are really thinking long-term, which is past year 10 in this case, because the NFL has contracts through 10 years.
Be interesting to see how it all shakes down. Laura Martin Needham, Senior Media and Internet Analyst. Good to talk to you today. Well, all your markets actions, stay tuned. You are watching Yahoo Finance. Well, there's no question we all fall victim to constantly checking our phones with notifications and alerts, regularly fighting for our attention. But Apple may actually be looking to make our devices less distracting. Yahoo Finance's tech editor, Dan Halley, has the details. Dan, I'm a little confused. Doesn't it help Apple for us to be distracted by the device because we use it more?
It does and it doesn't, right? Apple kind of wants to ensure that people use their devices, but doesn't want them to be seen as a distraction that then has negative connotations for the overall brand. But I managed to speak with Apple's Craig Federighi. He is, of course, the VP of Software Engineering, Senior VP of Software Engineering, I should say, as well as Alan Dye. He's Apple's VP of Human Interface. And they basically explained how they're using this thing called widgets, which have been around for a while, but are now being integrated into Apple's ecosystem, basically across the board, as a means of providing people with information without them necessarily being kind of shoved down people's throats as notifications. So think, you're at work, you have Slack, we have email, we have everything going back and forth, and you just have a deluge of notifications. The idea here, though, is to kind of cut back on that, allow people to get information when they want to through these widgets, and then they don't necessarily end up going down rabbit holes if they have that information immediately available on their home screen, on their iPhone, on their Mac, or on their Apple Watch. And that's generally the thinking here. You'd be able to go to your home screen, be able to see if you're driving or if you're getting an Uber, where your Uber is in the dynamic island. If you're following fantasy football and losing to your wife like I am, you'd be able to get that in the dynamic island as well. The weather, your calendar, all of those can exist as widgets. And so the thinking is, you get all of that data right there, rather than having to dive into individual apps. Then for whatever reason, you end up on Reddit reading about, I don't know, the Revolutionary War for an hour and a half. So it's about keeping people more, I guess, in line with what they actually need, rather than ending up having them go down these rabbit holes. And it's an interesting way for them to design products, right? They're as you said, you would think it would help them if people were using their devices nonstop. But for Apple, it seems they want people to get information when they want to, not when apps want them to.
Okay, we'll see if it works. I will fully admit to being distracted on my phone all the time. And also constantly. The tabs. Dan, they've got to find a way to get rid of the tabs, right? I've got like 40 tabs up right now, but that is for another story. Dan Halley, thanks so much for that. Let's do a final check of the markets before we let you go. We have seen all three majors coming off of the session lows, but the Dow down 14, the S&P 500 down 7, and the Nasdaq down 76 as investors continue to monitor the fallout from that ongoing conflict between Israel and Hamas. And we will have all those updates for you throughout the day. That does it for me in the 11 a.m. Eastern hour. I'll be right back here tomorrow.